Declare recess of the committee at any time. This hearing is entitled Housing in America, Oversight of the Federal Housing Finance Agency. I now recognize myself for 4 minutes to give an opening statement. First, I'd like to extend my congratulations to Director Sandra Thompson, who has dedicated her career to promoting access to mortgage credit nationwide and protecting the safety and soundness of the housing finance system. Her confirmation marks the first time in our nation's history that a Black woman leads FHFA. Director Thompson, we are very pleased to have you here. Today, we continue the committee's oversight of FHFA. As we all know, FHFA is responsible for the supervision, regulation, and oversight of the government-sponsored enterprises, which includes Fannie Mae and Freddie Mac, as well as the Federal Home Loan Bank System. I know my Republican colleagues have recently complained about a lack of oversight hearings pertaining to housing finance. However, this comes as a surprise, given their repeated complaints that this committee has held too many hearings on housing, over 30 to be exact. But let's get the facts straight. It was their former director collaborator who, in December 2020, refused to appear before this committee despite our repeated requests. And it is Republicans in the Senate who have actively impeded our ability to confirm federal agency leadership, including Director Thompson and FHA Commissioner Julia Gordon. So after 4 years of terrible stewardship by former Director Mark Calabria during the Trump administration, I'm relieved that FHFA is finally back to fulfilling its intended mission. Under Calabria, FHFA made it several irresponsible and dangerous moves that harmed borrowers in the housing finance market, including attempts to sidestep Congress and release the enterprises from federal conservatorship. In sharp contrast, Director Thompson's actions have been reasonable, fair, and grounded in facts and the law. In just a year, Director Thompson has taken critical steps to set FHFA on a new path forward by eliminating Calabria's unnecessary and harmful policies that made it more expensive for families to buy or refinance their homes, strengthening renter protections, and expanding access to credit through the use of additional credit data like on-time rental payments. Director Thompson has worked to fulfill her regulatory mission over the enterprises by recommitting to comprehensive fair housing and fair lending practices of the enterprises. For example, Director Thompson most recently led the historic effort to require the enterprises to develop and implement equitable housing finance plans to address the gross racial inequities in their books of business and to ensure they prioritize innovative, equitable practices that benefit everyone. And we expect full transparency in these efforts, including public-facing metrics that show concrete, measurable reduction in racial inequity. FHFA plays an instrumental role in our housing finance market, especially as our nation continues to face a housing crisis that has been made worse by Republicans' refusal to support meaningful investments to increase the housing supply, reduce the housing costs, and offset inflation. So I look forward to continuing our work with Director Thompson to put borrowers and communities first. And now, I recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Thank you, Madam Chair, and Director Thompson, welcome to your first appearance before the committee as a director, and we're grateful you're here. We want to congratulate you on your confirmation, and we hope that this is the first of many appearances in an oversight fashion before the committee. I'm sure you look forward to that, but in a different way that we look forward to it. But this hearing is important for many reasons. The first and foremost and obvious reason is the Federal Housing Finance Agency's regulation of government-sponsored enterprises such as Fannie Mae and Freddie Mac, as well as the 11 federal home loan banks. Combined, these entities hold more than $7.5 trillion in mortgage assets, with GSEs financing roughly half of all new mortgages originated in the U.S. each year. This makes them arguably the most important component of our housing finance system, despite the fact that they were put in conservatorship and nationalized under Bush 43. The second reason for this hearing is important is that it marks this committee's return to actually doing its oversight job. There'll be more to come of the oversight agenda, but it's been nearly 2 years since the chair has held a hearing with FHFA. That was when former Director Mark Calabria came to discuss his successful COVID response, which helped protect homeowners and taxpayers from the total economic meltdown that it was at the beginning of COVID. This earned Director Calabria much praise, followed by an unceremonious and unjustified firing by the Biden administration in June 2021. After that, Ms. Thompson served as acting director for nearly a year, and it's taken another 2 months since her confirmation for to be here before the committee, being invited before the committee. And there's no telling how long that streak would have continued. Last month, subcommittee ranking member French Hill and I sent a letter to the chair requesting that she invite Director Thompson to testify at the June housing hearing. So let's hope this doesn't turn out to be another case of too little too late, like the administration's response on inflation or gas prices, supply chain failures, or the rest of the economy. Such blatant mismanagement has done real and lasting harm to American households. Congress's neglect of the FHFA and some of its recent decisions threaten to do even more harm. As the chair noted at last month's hearing, quote, rising home prices are directly contributing to inflation, end quote. Mortgage rates have nearly doubled over the last year to levels unseen since 2008. Meanwhile, instead of working to maintain stability, FHFA has weakened our housing finance system by reducing taxpayer protections and pushing new risky schemes. For example, the agency rescinded the capital and liquidity rule designed to ensure that the GSEs could weather an economic downturn. We're concerned about that. FHFA has also refused to complete work on the 2020 proposed rule on prior approval of new GSE products and pilot programs. That's of concern as well. And most importantly, FHFA compelled the GSEs to issue disastrous new and controversial equitable housing finance plans, which violate the spirit of that proposed rule. This is FHFA's focus, as soaring housing costs and mortgage rates price hardworking families out of the market. American homeowners and prospective home buyers deserve a fair system in which they can reasonably pursue the American dream. And I think that's our shared goal here. Inflation and instability do not support that objective, though. And I hope that we can use this hearing to get some answers from the new director on her plans to make homeownership an attainable goal for all Americans. Thank you, Madam Chair.
Thank you very much. I now recognize the ranking member of the committee, the gentleman from North Carolina. Oh, I'm sorry. Thank you, Ranking Member McHenry. I now recognize the chair of the Subcommittee on Housing, Community Development, and Insurance, the gentleman from Missouri, Mr. Cleaver, for 1 minute.
Thank you, Madam Chair. FHFA's mission through supervision of regulated entities is to foster a sustainable housing finance system that supports equitable access to both affordable home ownership and rental housing, reaching communities of color, rural areas, and other underserved populations, which is a description of my congressional district. Frighteningly, all across the United States, there is widespread lack of affordable housing and access to credit, problems that are especially concentrated in communities of color, and low and moderate income Americans are increasingly cut off from housing opportunities. FHFA plays a vital role in both promoting equitable access to mortgage credit nationwide and in protecting the safety and soundness of the housing finance system. I am very pleased to welcome Director Thompson, who is widely respected for her deep expertise and leadership in housing finance. Under Director Thompson's leadership, FHFA has already taken significant steps to promote access and protect the financial standing of housing finance system, and I look forward to continued dialogue on advancing the FHFA's mission. Thank you, Madam Chair.
Thank you, Mr. Cleaver. I now recognize the ranking member of the Subcommittee on Housing and Community Development and Insurance, the gentleman from Arkansas, Mr. Hill, for 1 minute.
Chair Waters, thank you for agreeing with Ranking Member McHenry and I to invite Director Thompson to our committee today. I would urge the committee and the staff to recognize this responsibility as an annual responsibility under the statute to have the director testify. Director Thompson, terrific to have you. Congratulations on your confirmation. In just 10 days, the Federal Housing Finance Agency will turn 14 years old. In its dual role, both as a regulator of the GSEs and conservator of Fannie Mae and Freddie Mac, FHFA has a huge influence over our housing market and the entire American economy. You have awesome powers. This comes at a time when house prices are soaring to record levels and families seeing their mortgage rates skyrocket. So I look forward to your testimony today about your vision for FHFA, your 2021 report to Congress, your plans to finalize long overdue new products and activities rule, and to ensure that taxpayers are protected in the face of what I believe is financial laxity in your policies at the agency. And I yield back. Thank you, Madam Chair.
Thank you very much.
Madam Chair, I ask a point of personal privilege.
The gentleman is recognized.
I just want to take a moment to note a distinguished guest we have in the audience, and that's Mr. Clinton Columbus Jones, who has worked on this committee for 24 years before making the jump to FHFA. And he's now the general counsel. You know, this is the room where it all started for Clinton. We'll skip over the HUD time before that, Clinton. But I wanted to, on behalf of the committee and the 7 chairs under which Clinton served, I want to say happy birthday. Today is Clinton's 32nd birthday. We say happy birthday, Clinton.
Thank you very much for welcoming Mr. Clinton back in a different position. I don't want to know about him. I want to know about his son.
Oh, that's so true.
Thank you. I want to welcome today's distinguished witness, the Honorable Sandra L. Thompson, Director of the Federal Housing Finance Agency. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer and quickly wrap up your testimony. Director Thompson, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and distinguished members of the committee, it is a great honor to appear at today's hearing. My name is Sandra Thompson, and I'm the Director of the Federal Housing Finance Agency. I've had a 30-year career as a financial regulator. I served more than 2 decades at the FDIC and just over 9 years at FHFA. I was sworn in as director just last month after serving as acting director for the past year. From my experience through 2 financial crises, I've learned that safety and soundness and sustainable access to credit work together to strengthen financial institutions, families, and the economy. Actually, sustainable access to credit requires prudent lending standards. The enterprises have been in conservatorship for nearly 14 years, and their financial condition is a high priority for the agency. Although the enterprises are now retaining more of their earnings and building capital, it should be noted that there's still a long way to go to meet their regulatory capital requirements. As of the first quarter of this year, Fannie and Freddie combined had more than $80 billion in capital reserves. In February, FHFA finalized important enhancements to the capital framework. These changes have enabled the enterprises to improve their capital position and have provided them with the necessary incentives to transfer mortgage credit risk to private investors. This helps protect taxpayers while still requiring the enterprises to hold a substantial amount of capital. The housing market has faced several years of rapidly rising home prices and limited housing supply. In addition, interest rates have risen nearly 250 basis points in less than 6 months, making housing affordability a real challenge. I share your concern about the struggle for many homeowners and renters to find an affordable place to live. FHFA is taking incremental steps to help increase the supply of multifamily rental housing by raising the enterprise's low-income housing tax credit investment allocations, which is an important source of funding for new affordable rental housing. We also required that at least 50% of the enterprise's multifamily businesses be mission-driven affordable housing. FHFA has taken a number of steps to continue providing liquidity in underserved areas. We recently proposed new affordable housing goals for the enterprises and asked them to strengthen their duty to serve plans. The statutory duty to serve is particularly important because of its focus on areas with a great need: rural and tribal areas, manufactured housing, and affordable housing preservation. In addition, the enterprises recently published equitable housing plans to help identify and address barriers that prevent otherwise qualified homeowners from gaining access to mortgage credit, particularly in communities of color. Under these plans, both enterprises will consider a borrower's positive rental history in the underwriting of a mortgage. This is data that has not traditionally been included in the calculation of credit scores. It is one step in a series of efforts the enterprises are exploring to help expand sustainable homeownership opportunities for underserved populations and support a more equitable housing finance system. While there's a lot of attention on the enterprises, the home loan bank system is also important as it provides critical support for small and community banks. As we near the 100th anniversary of the banks, now is a good time to re-examine their approach to ensure they continue to serve the needs of today and tomorrow. We plan to engage a variety of stakeholders in the coming months as we complete this review and, of course, welcome the input of members of Congress. These are just a few of the many ongoing initiatives at FHFA to fulfill its mission of ensuring the safety and soundness of our regulated entities and promoting access to affordable and sustainable housing. Before I close, I'd like to acknowledge and thank the dedicated public servants at FHFA who work diligently to accomplish our mission. Thank you again for the opportunity to testify before you. I look forward to working with members of this committee and answering any questions you may have.
Thank you, Director Thompson. I now recognize myself for 5 minutes for questions. Director Thompson, FHFA has taken important steps under your leadership to begin to address the racial home ownership gap, including by taking a close look at appraisal disparities, expanding the eligibility for more affordable refinance options, and publishing the Equitable Housing Finance Plans of Fannie Mae and Freddie Mac, which marks the first time the enterprises have had to make intentional plans to redress racial inequities in their books of business. Can you tell us more about what your approach has been in targeting inequities in today's housing market, and what further steps you might take to help improve equitable access and fair pricing for historically underserved and excluded borrowers?
Thank you for the question. First, I am a career safety and soundness regulator, so everything that we do at FHFA is going to be grounded in safety and soundness. After the last crisis, we learned a very valuable lesson, and the thing that I took away from that is that safety and soundness and access to credit are two sides of the same coin. They work hand in hand for the betterment of our country. One of the things that we've done at FHFA is to focus not just on standard business that the enterprises buy in terms of loans, but we've also asked them to focus on underserved communities. This includes rural areas, tribal communities, and other areas where there are just not enough access to liquidity. One of the more recent things that we've done is we've asked the enterprises to look at previously redlined areas and try to figure out what barriers exist for borrowers who are otherwise qualified, who are not able to access credit. We believe that some of the initiatives that the enterprises will undertake in this area will benefit all homeowners and potential homeowners. I'll give you the example that I used in my oral testimony. One of the things that both Fannie and Freddie are doing are incorporating positive rental payments into the underwriting calculation. This is practical. A home or a rent payment is the largest payment most people make every single month. And if people are able to pay their rent on time, why shouldn't those payments be considered in terms of determining whether they are able and or willing to pay? And so this is an opportunity that was included in the Equitable Housing Plan, but it applies to all borrowers or all renters. And we just think that things that can be impactful will impact the entire population.
Thank you for that answer. I'd like to go on. While the skyrocketing appreciation of home prices during the pandemic has put home ownership even further out of reach for many, research from the Urban Institute has shown that there are still some communities throughout the country where home buyers can purchase homes for less than $100,000, but only if they can pay all in cash, because mortgage lenders are unwilling to make such small mortgages. In 2019, over a quarter of all home sales were for homes priced at or below $100,000. Yet only 1 in 4 were financed with a mortgage. These are some of the most affordable homes in America, and they're out of reach because of a lack of financing. Is there anything that FHFA can do to help encourage more small dollar mortgage lending? Is there any legislative authority that you need to tackle this issue? I'm certainly interested in working with you on it.
So certainly, and we believe that small balance loans and providing financing for those loans are very important, whether it's purchase or refinance. And one of the items that we've directed the enterprises to look at this year, and it's in the scorecard that sets the forth their priorities, is to look at ways to enhance more small balance loans. And we would be happy to work with the committee on any legislation that would be helpful in that area.
Well, thank you very much. And now I will call on the ranking member for his questions.
Thank you, Madam Chair. And Director Thompson, thank you for your career in public service. Your skill set is well attuned to being a safety and soundness regulator, because that's what your career is in. So though the market is different than your previous career, you have the skills for this, and I'm grateful for that, especially considering how large the portfolio you oversee is and how important it is to the American economy. But let's start with oversight. Under the statute, under HREA, we have a requirement to testify annually. And so is it your intention to follow that statute?
Sir, it is my intention to be at the call of the committee whenever they request me to come up with full committee or individual members. I'm happy to do that.
Thank you. We're concerned about transparency, right? You have a very important agency. You don't have a statutory broad requirement for transparency other than the testimony piece of that. And so we'd like to hear more about your plans going forward. But let's start with what you oversee, which is the housing market. We had an all-time low mortgage rate of 2.65%. 18 months later, we're back to 6-7% mortgages. We have inflation. Give me your view on the outlook of the housing market.
Sure. Well, the housing market has been very volatile in the past 6 months. As you've mentioned, we went from record low interest rates to an increase in interest rates, almost 250 basis points in about 6 months' time. And we've also had a persistent supply issue or lack of not just affordable supply, but supply generally. So when you look at the rising interest rates, when you look at the lack of supply, you also have seen a historic increase in home prices, which is tempering just a little bit. But when you look at all three of these components, it is really difficult from an affordability perspective to have borrowers be able, or prospective borrowers to be able to get homes. Certainly what they could afford 6 months ago, they can't afford now because the interest rates have almost doubled. And it is just an environment that's very challenging. You know, when there's the supply issue is also quite challenging because there just isn't enough supply, especially at the entry level for persons to enter home ownership. So we look at the characteristics of the mortgages that both Fannie and Freddie are buying. We look at interest rates. And in fact, after 2021, which was a record year for refinances, we looked at the portfolio, and there were still mortgages on the books that had been there for a while that had interest rates of over 5%. And we were just wondering why people were not refinancing or taking advantage of those opportunities. So we look at trends, we look at risk characteristics, we look at loan factors so that we can make assessments on the risk profile of the profile of the enterprise.
Okay, so let's get to that risk profile. Congress from time to time has had plans to get these enterprises exited from conservatorship. The Republican side of the aisle put out a bill for 2 Congresses on that. We welcome discussions from our committee Democrats on this and welcome the housing finance reform discussion. This hearing gives me the opportunity to say that to them publicly. But along those lines, there are pros and cons to conservatorship. And for this sort of halfway point that we have that you're overseeing. So what are the cons? What are the pros?
So, first, after coming from the FDIC, I don't think it was anybody's expectation for the enterprises to be in conservatorship for 14 years. But I would say that some progress has been made just in terms of standardization, in terms of alignment. When the pandemic arose, for example, we were able to call the enterprises together and put together new policies for loss mitigation so that borrowers who were impacted would have opportunities to be reinstated with their mortgages, and it just wouldn't be the pandemic wouldn't be as impactful as it was. And so there have just been servicing standards have been aligned, data has been aligned for the mortgage industry. So there's just been a lot of positive improvements over time. The one issue in terms of a con, I would say, is just the uncertainty about the status of the enterprises. I'm the 6th director, and this issue has been in place, 4 administrations, 6 directors, and continues just in terms of, what is the future of the enterprises, how are we going to get together, and it's just the uncertainty that is about the future that probably needs to be addressed by the Congress. But I do think that, there are pros and cons, and I do think that, the decision as to what happens certainly is up to Congress.
Thank you.
Thank you. The gentleman from New York, Mr. Meeks, who is also the chair of the House the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for having this very timely hearing, and congratulations to Ms. Thompson on being the director of the Federal Housing Finance Agency. We know that you're going to do a very great job at it. And so, Director Thompson, one of the things that I have found to be a huge barrier to home ownership of communities of color in particular that has crippled they're crippled by student debt, and it serves as a massive hindrance to being able to make the next step towards generational wealth building. Many years ago, that was one of the things that was hard for me. I had all the student debt, but I wanted to buy a house, and there's different consideration. This debt has serious implications for qualifications for loans. That's what happened to me. But the student debt is not always treated the same by the various GSEs. I have a bill called Expanding Home Ownership for Borrowers with Student Debt Act, which requires certain agencies to more fairly treat student loan borrowers looking to obtain an affordable mortgage through various programs. So what are the positive impacts that this type of uniformity and alignment can have on student borrowers as their student debt is assessed for loan qualifications, regardless of where they seek out their loan?
So thank you for the question. And student debt certainly is taken into consideration in different ways throughout the mortgage industry. And certainly, this is an area that we would be able to work with you on in terms of trying to figure out how it is assessed today and how it should be assessed going forward in terms of home ownership and also the impact on credit scores.
Yeah, I would love to work with you on that, and I'll have my office follow up with yours because, I'm still a big believer. The way that we close the wealth gap is home ownership. You look at folks today, even in the middle of this crisis, with the cost of rent, I'm still trying to get people to be homeowners, and so working with you and trying to figure that out is something that is of huge importance to me. Now, also, and I use a lot of times looking at the young people in my district, I have found that there has been a dramatic growth in fintech innovation, leading to some rapid changes in our financial markets, particularly in the housing space, where fintechs are changing the landscape of how underwriting and mortgage processes operate, including loan origination and assessing credit risks. Given this rise in fintechs, and I see all the young people, they just online when my daughter was buying a house, they didn't go to the bank, they went to a fintech. But, and I know that just this week, you announced that the establishment of the Office of Financial Technology at FHFA, which aims to evaluate the use of fintechs in housing finance. So what are some of the benefits as well as the risks you expect the office to identify? And will this office look to put racial equity at the forefront of their engagement with these issues?
Sure. So thank you. And we did this week establish an Office of Financial Technology. And as you mentioned, financial technology or fintech is used in the mortgage process, and we need to get a better understanding of what these products are and how they're used, and to make sure that they're used in a safe and sound manner. We do think that there are opportunities to use technology in the mortgage process because it takes a very long time to go from application through closing. And there has to be a way to try to make the mortgage process cheaper for the borrower, faster, and also when you use technology, you often get good risk management practices. One of the things that I mentioned, and this is something that we learned during the pandemic, was that when the interest rates were really low, people were trying to take advantage for refinances, and to refinance you have to have an appraisal. The appraisers didn't want to go into the homes, and nobody wanted to let appraisers in because this again was when the pandemic started. And we were able to use technology in a very meaningful way and introduce desktop appraisals. And that's now one of the staples of the enterprises. It's one of the things that we learned during the pandemic that we've now made a permanent policy. And we think that these types of tools can be helpful in just the mortgage process in terms of making it shorter and also more efficient in bringing risk management to the process.
Thank you. I see I'm out of time. I yield back, Madam Chair.
Thank you very much. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman, and I am so very pleased that we are having a most relevant housing hearing at last. Director Thompson, I thank you for joining us today. It has been far too long since this committee has been able to perform its duty to conduct oversight at your agency. I appreciate your willingness to be transparent and to be willing to take our calls and meetings. With your significant safety and soundness regulatory background at FHFA and previously at the FDIC, what precautionary and preemptive steps are you taking with the GSEs as they head into these economic headwinds, that's all we can call them, of interest rate hikes, a lack of housing supply, unsustainable home price appreciation, and inflationary pressure?
So thank you for the question. And again, I am a lifelong safety and soundness regulator, and we take that responsibility very seriously. But we also couple that with access to credit. And just want to really be clear that when we talk about access to credit and we talk about affordability, we're also talking about sustainability. So our work with the enterprises is really grounded in safety and soundness, and we want to make sure that borrowers have loans that they understand and loans that they can afford. And from our perspective, it just doesn't make sense for a borrower to get into a house and not be able to keep a house. So we're really focused, laser focused on sustainability.
Well, these are very rocky times, and we
Yes.
don't want people to get in over their heads, and we hope that there'll be more settling down and stability in the market. Whether you agreed or disagreed, ma'am, with his views, your predecessor had a clear vision for the enterprises and a plan to get them out of conservatorship. What is your vision for GSE reform?
So we are taking steps to make sure that the enterprises are run in a safe and sound manner and that they are continuing to build capital. As you know, the enterprises were just allowed to retain all of the capital that they earn just over a year now. And between the two of them, they have about $80 billion in capital. So we are consistently allowing the enterprises to build capital. We're also putting in place the provision to allow them to transfer credit risk away from the enterprises and also the taxpayers to private investors. As you know, the enterprises are probably the largest holder of mortgage credit risk in the country, and to move that credit risk to the private sector, we think is really important. So there are a number of steps that we're undertaking that have to be in place.
Let's talk about that for a minute, because Director Thompson, under your leadership, the FHFA revised your predecessor's capital rule, which will result in the enterprises holding less capital and therefore being more vulnerable to losses that taxpayers will have to bear. Director Calabria's rule would have required the enterprises to hold around $250 billion in combined capital, which was above their previous $45 billion capital on retained earnings. In revising the rule, did FHFA calculate what the impact of the changes to the capital rule would be in terms of how much capital the enterprises would be required to hold?
Yes, another good question. We did take into consideration the capital requirements. The reason that we changed the rule was to really help facilitate credit risk transfer. A credit risk transfer program is really important because, again—
And I'm running out of time. Do you have a specific number?
Yeah,
Can
I
you
do.
describe the process, something?
Absolutely.
That's what I'm looking for here.
Right. So the number that was that's going to be required, I think before was $316 billion. Now it's $300 billion, and there was a de minimis change. But the purpose was to really move the credit risk to the private investors.
So you're going to make sure that they're holding around over $300 billion in combined capital.
That's the requirement, and of course that changes based on the assets, the amount of assets that they hold.
Because we don't want to weaken the capital buffer as we're heading into what could potentially be here a recession. Do you agree that it makes more sense to strengthen the capital reserve at Fannie and Freddie to avoid another taxpayer bailout?
Yeah, yes, I do agree that it is important to strengthen the capital reserve, but we also think it's important to transfer credit risk outside of the system to private investors.
I thank you for your input, and I yield back.
Thank you. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you. And the first thing I want to say is congratulations. You've made history, and you are now the first woman ever to lead this most important agency at the right time with the right person. Congratulations. First, Director Thompson, I want to ask you this. Back a couple of months ago in April 2022, your agency directed servicers of Fannie and Freddie Mac loans to pause for foreclosures for up to 60 days upon notification that borrowers applied for pandemic mortgage relief. And first, can you provide us with a specific number of mortgages impacted by your decision?
Certainly. We think that the HAF program, the Homeownership Assistance Fund, is really important. It was a provision put in place to help both borrowers and renters. One of the reasons we put the provision in place to put a halt on foreclosures was we didn't want borrowers or renters to be adversely impacted when they were trying to get access and then have a concurrent foreclosure or concurrent eviction. We don't have the specific numbers of all the borrowers that have been advantaged by that program, but we do know that many of the borrowers that were placed in forbearance plans by the enterprises, about 96% of them have now exited those plans.
So they were successful in reducing a borrower's monthly payments then. Now, secondly, what is your agency's projection of how many homeowners will be unable to resume regular mortgage payments after they leave forbearance, and what do you expect will be the outcome for them?
Sure. So at the start of the pandemic, about 2.2 million borrowers entered into forbearance plans. Today, there's not 100, it's probably about 90 some odd thousand borrowers that are still in forbearance plans. 96% of borrowers who entered forbearance plans have exited them. And what we found that was particularly interesting was that there were a number of people that were in these forbearance plans that continued to pay even though they had signed up for the forbearance. And we put in place some modifications so that borrowers would not be as severely impacted as they otherwise would if they had the option to defer their payment, and then the deferred payments, they could reinstate them, or they could pay them over time, or they get tacked on to the end of the mortgage. But there were lots of modifications that were put in place to keep borrowers in their homes. And so for the almost 100,000 that are left, they're in modification programs, and we're hoping that they will have successful workout solutions.
Now, Director Thompson, I want the nation to know, because one of the most startling statistics when we're discussing racial inequality in housing is this, that the Black home ownership rate has remained virtually the same as it was in 1968. This is startling. And right now, there are thousands of young people in my district and all of our districts and millions across the nation with a dream of owning their own home one day, but who simply cannot afford a mortgage payment. So let me ask you this. What steps is your agency taking to ensure that first-time home buyers and first-generation home buyers who lack intergenerational wealth can realize their goal of home ownership?
Thank you. And again, certainly to your point, there were a lot of gains that were made, but they were lost in the Great Recession as we saw record numbers of foreclosures, particularly in communities of color, where there were a lot of predatory loan practices. Having said that, one of the ways to close the equity gap is through homeownership, and we want to, again, put in place, or Fannie and Freddie have programs in place that allow credit-worthy borrowers to take advantage of first-time homebuyer programs where they have homeownership education and they understand what homeownership means. One of the provisions they put in place that we think will be really beneficial is to be helpful by incorporating the rental payments into their credit scores, because some people don't have credit built up.
Thank you so much, and again, congratulations. I look forward to working with you.
Thank you very much. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. Director Thompson, thank you for taking time to be with us today. I've got a piece of business that I simply want to bring to your attention, Madam Chairman. I've got a letter that I would like to have entered into the record.
Without objection,
Thank
such
you
is the
very
order.
much. This is a letter that I have, Republicans, I'm a Republican, have been working with the Secretary of Housing and Urban Development for months on getting more housing in Texas. And we believe that there are rules and regulations which could be waived by the Secretary. In essence, it goes through it here. I just want you to be aware of it, and I'm going to make sure that your staff gets a copy. But what we're trying to do is get the Secretary to look at ways within her discretion that she could waive some rules allowing more building without having to tear down something that corresponds to that, like it's a 1-to-1 ratio, when in Texas, we need more housing. And I just appreciate your attention that you have not been brought into this, but I want you to be aware of it. The young chairwoman is also getting this for the first time. Director, I am interested in hearing from you about the president's call across all of government as it relates to equality and gender, about how you apply that within your agency and how that is being applied to the loan-taking process.
So thank you. Certainly, we at FHFA are responsible, as all the other financial regulators, to adhere to the Fair Housing Act, which looks at equality in housing.
Yes, ma'am, but you were given that under the law also. I'm talking about specifically anything new or different that you may have undertaken. What I'm particularly interested in is that it be applied equally to everyone else too, not necessarily to a selected group. And I do think it's important, as the president has noted, that they pay close attention. But I'm wanting to ask, have you taken other facts or factors into play as a result of that direct
Sir,
order from the president?
So our primary objective is to comply with the law and to make sure that it's applied in our regulated entities. We certainly look at programs and then policies, but we, again, first want to make sure that they are in compliance with the regulations that are undergird our authority. And so, again, the Fair Housing Act probably has more credence to looking at certain characteristics. But we want to make sure that the programs and policies that are applied at Fannie and Freddie apply to all persons who are eligible and meet the criteria.
So in other words, you have not utilized any different discretion. You have not utilized anything necessarily different with the president's request.
I don't think that I have done that.
So you have not done anything. It's you looked at the law. You looked at the law as needing to be fair and equitable anyway, and that you have not undertaken any steps within these agencies to direct them or to have them change the processes that would have been available under the law. That's what I hear your testimony is saying.
That is correct, sir.
Okay. All right. Thank you very much, because we are very interested in the success that you have spoken about of being fair and doing these things, because with the increase of rates, interest rates, it is becoming even more critical for people to land within the housing that is properly within their scope. The chairwoman and I lived through what happened in 8 and 9, and we want to make sure we're not going to create any sort of a bubble, any sort of an articulation of federal policy that would do anything other than following the law as it has been and as it is now. And I appreciate the gentlewoman for her testimony before this committee. Thank you very much. I yield back my time.
Thank you. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. It's an honor to serve under your leadership. And I'd like to thank the director and salute her for having the opportunity to serve in such a high capacity within our government. I'm confident that she will do a stellar job. Madam Director, I'd like to address two issues. The first has to do with something that you have called to our attention about purchasing homes. People who can pay rental payments timely are likely to be able to make a mortgage payment timely. This is something that I concur with. In fact, I concur with it to the extent that I can share with you HR 123, a piece of legislation that I have filed in multiple Congresses. It's called the Alternative Data for Additional Credit FHFA Pilot Program Reauthorization Act. Reauthorization because we actually passed it in Congress once. So I salute what you're doing, and I would like to have you take a look at my HR 123 because I'm curious as to whether you think that it might in some way conflict with what you are doing currently. I salute what you're doing. I don't think we can do too much to help people who need some opportunity to own property, which is a means by which they can build wealth. HR 123 would have additional credit scoring in the area of rental payments, light bill, gas bill, water bill, phone bill, the things that are not automatically scored. They would then become a part of a pilot program to have them scored, such that we can examine not only the efficacy of simply scoring, but also the mechanics of doing it. I think it's a pretty good bill. I've sponsored it multiple times, and I'd like to have you take a look at it, if you would, to give me some commentary as to whether or not it would conflict with what you're attempting to do with your program. I yield to you for a comment, please.
Sure, we are happy to work with you on this very important issue. We do believe alternative data in evaluating credit is very important, and we're happy to look at the bill.
Thank you. I'll make sure that we get it to you immediately, if not sooner. Now, also, I'm concerned about the lack of homes available to first-time home buyers, to persons who are renting, young people, millennials, and Generation Z persons who are trying their very best to get into their first home. I'm concerned because I have had a hearing under the leadership of the Honorable Maxine Waters. We had a hearing, and one of the things that I discussed at the hearing was a concept known as predatory purchasing. We have these major corporations with deep pockets that are buying properties out from under first-time home buyers, and they are converting these to rentals. They, with their deep pockets, can make cash offers. The cash offer in and of itself will shut out a good many persons who have to purchase with credit. My concern is with the predatory purchasing and how it's impacting the housing market. Currently, I have an indication that we need some 300,000 plus 328,000 new apartments annually to meet the demand. That demand is being thwarted to a certain extent by this predatory purchasing, in my opinion. Are you familiar with what I speak of? And if you are, can you give me some thoughts as to how we might manage to let young people have the opportunity to purchase their first home, to keep homes on the market for first-time home buyers as opposed to having them become rentals, wherein persons with these deep pockets can raise rents and become very profitable for them, but doesn't help those who are seeking homes. I yield to you, Madam Director.
Right, so we are very familiar with that issue, and in 2018, we prohibited the enterprises from engaging in sales with large institutional investors, and this is particularly true in the single-family rental space. I think both enterprises had pilot programs, and we stopped those, and they're no longer able to purchase through these loans or these homes through from these large institutional buyers. One of the things that we're doing on the enterprises REO portfolios is we have what's called a First Look program, and it is a 30-day window where an owner-occupied or potential owner-occupied person has an opportunity to bid on the loan, or a nonprofit. And so there's a 30-day window whereby which owner-occupied potential tenants or borrowers can take a look at these properties before investors start purchasing them. But I do think it's important that we make homeownership affordable, and that all people have the opportunity to purchase these mortgages, especially those that can't afford to pay cash.
Thank you, Madam Chair. My time has expired. Thank you so much.
The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Madam Chair. Time expired while Director Thompson was answering Congressman Green's question, and I'm willing to allow her some extra time if she wanted to expand her thoughts on that a little bit further.
Oh, thank you. I'm fine, thank you.
Okay. We still call them government-sponsored enterprises, or GSEs, but for the last 14 years, Fannie and Freddie have been government agencies, pure and simple. During the last 14 years, I'm just curious about what FHFA leadership has done to improve the safety of the loans securitized by these agencies.
So when we look at the enterprises portfolio, because of the low interest rates, a lot of the risk was removed through refinances, where people were able to reduce their mortgage payments. We also have seen increase in home prices, which means that the loan-to-value ratios have decreased on the enterprises portfolio, which means that homeowners' equities have increased. And so we think that the portfolio, as evidenced in terms of how it performed during the pandemic, is in a very good position to weather a storm. We do monitor the loan characteristics that are the enterprises purchase, and we make sure that they are operating in a safe and sound manner. Again, we do take a look from a safety and soundness perspective at every single thing that the enterprises do, and we want to make sure that they continue to be in good financial condition.
Thank you. The FTC and the Justice Department are apparently reviewing the merger between mortgage software firms ICE and Black Knight. I'm just wondering if you have any concerns about this big tech merger and its potential impact on the GSEs and ultimately on consumers.
Yes, I don't have any thoughts on that particular issue, sir.
Do you have any plans to remove Fannie Mae or Freddie Mac from conservatorship?
Excuse me, could you repeat the question? I'm sorry.
Do you have any plans to remove Freddie or Fannie from conservatorship?
Sir, we are working on, again, improving the financial condition of the enterprises. We think that the future state of the mortgage secondary market ought to be determined by the Congress. But again, we are taking steps to allow them to build their capital. They're transferring credit risk. We also implemented a capital planning requirement for both enterprises, as well as a capital disclosure where they have to disclose information about their capital position. We think that those things are steps that move them towards taking good steps to move towards whenever they are out of conservatorship.
Thank you. Data from your agency says that Fannie and Freddie purchased 62% of all mortgages originated in 2020 and purchased on average 54% each year from 2002 to 2020. What is the administration's vision for increasing the role of the private sector market in the secondary mortgage market?
Well, I know that the enterprises really play a countercyclical role in the mortgage market, as evidenced by what happened after the Great Recession and also what happened in the pandemic. I think when there were sources of liquidity that were not available to borrowers across the country, the enterprises did step in. And so we do believe that there is a role for the enterprises. They play a countercyclical role, and they certainly did step up and make purchases during and after there's a crisis, in particular the pandemic.
Now, given what happened before the financial crisis, would it make sense to limit government exposure in the secondary market to those activities that meet our objectives for low to moderate income home ownership and leave the remainder of the market to the private sector?
Well, I think the statute requires us to provide liquidity to all Americans across the country, and based on their eligibility, borrowers can get mortgage loans. And so I think that would be something that would have to be decided by the Congress.
Very good. I thank you for your direct answers, and yield back the balance of my time, Madam Chair.
The gentleman yields back, and I now recognize myself for 5 minutes. The gentleman from Texas, Mr. Sessions, had mentioned a few minutes ago the one-for-one HUD policy. Well, he didn't mention one-for-one HUD policy, but there is a one-for-one HUD policy. We can only build a new unit or support financially a unit that has been demolished, and we ended up having a number of those during the Katrina crisis. The chairwoman and I, along with Mr. Green, toured some of those projects projects which all of the units had been damaged and needed to be demolished. We ended up, I think, replacing one unit because of the policy. And if the gentleman from Texas is interested in this, it's something that we can address, but only with an increase in the HUD budget, which we have tried to do almost each year. And it's not anything that I think FHFA is involved with. It's a HUD policy. But let me say I would love to work with Mr. Sessions on dealing with that issue and an increase in the HUD budget. My home district would not be this high, but the average housing price is over $500,000 in the United States. As I said, in my district, it would be less. And so we're always looking for ways in which we can construct the badly needed housing, affordable housing. And one of the things that I have become quite interested in is the cross-mod homes. They're manufactured homes. They're built to meet constructional and architectural design standards. And they're also consistent with site-built homes. We have a number of problems. One of them is that there's appears to be an appraisal bias against the HUD code label, which has distorted and made inaccurate appraisals of these homes. And I'm trying to figure out ways in which we can remove how we can remove the barriers for a significant source of affordable homes for American families. And so I'm hoping, Madam Director, that you can address in some way, both here and in your policies, cross-mode homes by addressing the barriers to their adoptions, such as ensuring enterprise guidance will ensure accurate appraisals. If we don't get accurate appraisals, we're not going to be able to move to this form of housing, which has changed dramatically from when I was a kid. Nobody wanted anything to do with this. You want to move away from it. But now they've changed and they meet most standards. But is there a way in which appraisals can be examined to allow these cross-mod homes to be acceptable?
Yeah, so we believe that manufactured housing can be a huge benefit to addressing the housing supply issue. We're very much aware of the cross-mod appraisal issue, and we're working with our regulated entities to see what flexibilities there might be in that particular situation.
Are you having any ongoing contact about these
Yeah,
homes?
actually, I went, there was a housing event on the mall, and I went
Yes.
and walked through, and I actually saw those cross-modded homes and the manufactured housing that was there, and it was just, like you said, something that wasn't expecting and hadn't seen. And the issue about the appraisals was raised with me directly as I was taking a tour through those homes. And so we've committed to working with the enterprises to look at the specific issue that relates to appraisals for these properties. Because again, with the supply issue being so acute, we just believe that this could be a really good solution.
Yeah, I'm surprised. I was surprised at the new direction they're taking, and they were trying to attract congressional attention out on the mall. My time has expired. Thank you very much, Madam Director. The gentleman from Missouri, Mr. Luke DeMeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and Director Thompson, welcome. Good to see you. The capital rule you proposed recommends combined required capital for Fannie and Freddie somewhere between $250 and $300 billion. And this morning you mentioned $300 billion as your target. I'm glad to see that. I know I had lots of discussions with your predecessor with regards to this. I think this agency is tremendously undercapitalized, and I think getting it there is where we need to be. As a former regulator, I'm sure you understand the importance of capital to an entity, and we're certainly glad to see you there. When do you think $300 billion is the point at which the conservatorship can end?
Well, I think when the enterprises meet the capital targets, that's one component of exit and conservatorship. There are other factors that need to be taken into consideration. Certainly, conversations with the Treasury about, the senior preferred shares. There are conversations with the Federal Reserve about certain policy issues like single counterparty. What happens if the enterprises exit, and what's, other significant institutions' exposure to the Fannie Freddie stock. There are just a number of issues that really need to be worked through that, meeting the capital target alone just won't answer those questions.
Okay. One of the things that you've commented on a couple times, and I'm excited about, quite frankly, because that'll, again, had a lot of discussions with your predecessor with regards to moving some of this risk to the private sector, getting to the secondary market. Can you give me an amount or a percentage of what you think is adequate and what your target would be on that?
So we set targets for the enterprises to transfer credit risk each year through our scorecard, and they have to transfer, I think it's 90% of certain loans, the risky loans. I think the loans have to have a loan-to-value ratio of like 60% or higher. And so we look at, the enterprises book, and again, as you know, the enterprises are the largest holders of mortgage credit risk, so we want to make sure that they transfer through either the capital market structures or reinsurance structures a great amount of this credit risk to private investors, so that if there is something catastrophic, that the risk is not undertaken or borne by just the enterprises or the taxpayers, that private investors are bearing some of that risk.
Well, I think it's fantastic. I think moving those things off the books and into the private sector is extremely important. Just kind of curious, I know my colleagues will kind of laugh when I ask the question because I'm well known around here as being concerned about CECL all the time, the current expected loss ratio. I know, again, in discussion with your predecessor, he indicated this would be something you'd have to consider. Are you working with the new CECL regulations at this point and adjusting your reserves for that accounting rule?
Yeah, I am certain that our office of the chief accountant is working with.
You're not sure, though, the effect of it at this point?
Yeah, I'm not sure what the effect is
Okay,
right now.
I know I see my good friend Clinton back here. He can help me get that information, I assume. Okay, he's nodding. Thank you very much. Again, one of the things that is concerning right now, especially in this particular climate, is inflation and the proposed taxes that are being out there that I think hurt the affordability of housing. You mentioned it a number of times. Leadership that's been here this morning talked about affordability, inability of people to afford homes, high cost of those things. It's interesting. Yesterday I got some numbers that just floored me. The latest numbers for cost and goods services will cost the average American household over $8,600 a year. That's $165 a week in lost purchasing power compared to what they had a year ago. That's unbelievable. That hurts their ability to make those house payments that you have on the books right now with folks. Do you have the ability to talk to the president and oftentimes about affordable housing?
I have actually talked to the president about affordable housing.
Do you talk to him about the inflation problem that's in this country with regards to the increased value of homes that makes it, and the increased cost of building homes, and then the lack or the hit that the wages are taking, so that there's this twofold problem? Costs more to purchase a home, yet you have less buying power for the individual. Do you talk to him about that?
So I think there are a number of people that talk to the president about
Yeah,
those issues.
Madam Director, this is your job to worry about the housing industry, about the availability of affordable housing. You should be in front of his desk with your hand, getting some attention. Mr. President, this is a huge issue for my agency and the people of this country. Are you not having that discussion?
We have discussions with all of the housing regulators and all of the interested parties.
Including the
whether
president?
it's with the Economic Council, whether it's national or domestic.
Including the president?
housing. I have had conversations. I have been in a briefing with the president to speak about housing issues.
I'm curious as to
Thank you.
your
Your
response.
time has expired,
Thank you.
Mr. Luxemauer. Thank you. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Mr. Chair. I'm over here. Hi. First of all, I want to congratulate you like my colleagues did. I think you are the right person in the right place at the right time, and I also appreciate your background very much. Why don't we start with inflation? Mr. Lukemeyer brought it up, and I think it's a good idea to start with that. What is the inflation rate in England right now? Do you know?
I do not.
It's a little higher than ours. It's 9.4%. We're at 9.1%. In fact, if you looked at a lot of the industrialized countries, the advanced economies, they're running a little hotter than ours. We have an advantage that our unemployment rate is lower than theirs and lower than many of these countries. But anyway, when my colleagues on the other side love to talk about inflation, they make it as if only in the United States and only because of the American president do we have inflation. That's not true. The reality is that inflation right now affects the whole world, especially advanced economies. Anyway, I want to bring that out because they always have a good time beating up on all the people that come here about inflation as if it was only in the United States. I agree that we have to do something about inflation, but at the same time, it is the pandemic that has caused all of this, and now, of course, the war in Ukraine. I do want to ask a little bit about the issue of housing inflation. Now, over the last 40 years, the average U.S. house price has increased by more than 470%. Because of the increased cost of labor, constrained supply chains for housing materials, and local zoning restrictions, many families are being priced out of the American dream. In my district alone, the median list price for homes increased 14% last year, making San Diego one of the most expensive housing markets in the country. Can you speak to this aspect of inflation and how this recent housing appreciation impacts Americans in need of affordable housing?
Sure. So again, the rising home prices, the rising interest rates, which means that borrowers cannot purchase as much as they could have even 6 months ago, and then the supply issue that is just really acute has exacerbated affordability. We are starting to see just a little bit of easing in the increase in home prices. Last year, we had a record increase in home prices. I think it was like 18.5% year over year, and we're starting to see that slow down a little bit across the country, but there are pockets, as you mentioned, where there are huge increases in home prices, and it's really exacerbating the affordability issue. So we do look at that, and we are trying to figure out ways to be helpful. In terms of the multifamily business line, they are creating multifamily, Fannie and Freddie in particular are purchasing multifamily loans, and every loan that they purchase, about 50% of them have to be affordable. In addition, we've expanded their LIHTC allocations, which go to very affordable housing across the country. And so again, while Fannie and Freddie are not directly involved in supply issues, there are ways that they can try to be helpful.
Another concern of mine is that now that we are sliding out of the pandemic, and the help that we provided for homeowners and renters basically going away, that there will be people who can't afford to pay their mortgages, and they'll need some flexibility. Have you done any study, any look at how many people will be foreclosed upon because of this issue? And what can we do?
So I can tell you that when the pandemic started, there was a little over 2 million borrowers that entered into forbearance programs. And today, there's less than 100,000. I think there's about 94 or 95,000 borrowers that are still in forbearance programs. The enterprises have very effective loss mitigation programs. So when borrowers get in trouble, they can contact their servicers and they can go into a workout solution that would allow them to modify the loan or defer the payment. And so we are really focused on home retention. And so for those borrowers who are in trouble, they can contact their servicers and really try to get a loan modification or a workout.
Okay. Well, I think you're the right person at the right time for all this. So again, I thank you for your service. I wish you the best of luck, and I hope you do come back to us every year. Thank you for being here. Thank you, Mr. Chair. I yield back.
The gentleman yields back. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and to my good friend from California, I would just note that inflation rates for the most recent months in the selected countries that belong to the Organization for Economic Cooperation and Development, the industrialized countries, the vast majority of those countries, including all but one G7 country, have inflation rates lower than the United States. The countries that have higher inflation rates are in large part those countries that are uniquely impacted by the Ukraine situation. What is different about the United States is bad fiscal policy compounded by monetary policy errors. And so to my friend from California, if you're wondering about unaffordability of gas and groceries and housing, we need to look at our own policies with an eye towards reversing course on overspending and constraining supply, such as constraining the supply of energy. But let's talk about safety and soundness of the enterprises and get back on topic, Director Thompson. I am concerned about the increased risk-taking by the enterprises under various initiatives that have been recently announced by FHFA and/or the enterprises. One potential check on excessive or creeping risk-taking by the enterprises is maintaining a robust role for private capital in pricing credit risks ahead of and alongside the enterprises. This is obviously one reason that the charter requirement for private credit enhancement for higher loan-to-value mortgages exists. Requiring the enterprises to programmatically issue credit risk transfers is another mechanism which provides an independent market-based check on the risks that the enterprises are taking. And I compliment the director for working to recalibrate the enterprise regulatory capital framework to enable more credit risk transfers. My question is, can you tell us specifically what FHFA is doing to ensure that the enterprises continue to shed this risk to private markets through a variety of executions and counterparties to help limit taxpayer risk, and explain that tweak to the regulatory framework?
Sure. So thank you for the question. So credit risk transfer is something that's really important from a safety and soundness perspective. We can't have what happened in 2008 happen again. And the enterprises are, again, the largest holders of credit risk in the country. And so the credit risk transfer program that was started in 2013 has been very effective. There are a number of ways to transfer credit risk into the private sector so that if there's an unexpected or catastrophic loss, that the private sector is helping to offset some of those losses, because otherwise it would be on the backs of the taxpayers. So we every year set forth credit risk transfer requirements for the enterprises, and we meet with them on a regular basis to make sure that they're effectuating those transactions. And again, everything that we are doing is going to be undergirded by safety and soundness, because their financial condition is so important to us in making sure that what happened before doesn't happen again.
Let me also talk to you about your role on FSOC and the importance of enabling credit risk transfers through the private bank capital requirements, because if private bank capital requirements become excessively high, it's an impediment to CRT, to credit risk transfer. So in your role on FSOC, have you had a dialogue with the banking regulators and maybe the potential incoming Vice Chair of Supervision, Mr. Barr, around the appropriateness of also giving banks capital credit for credit risk transfer?
I'm happy to have that conversation with Acting Comptroller Sue, incoming Vice Chair of Supervision Barr, and Acting Chairman Gruenberg.
Well, that's important, and I appreciate you doing that. Final question. When the FHFA updated the conforming loan limits for single-family mortgages that can be acquired by the GSEs, you raised the baseline over 18% or $100,000. These new limits will allow Fannie and Freddie to subsidize the purchase of an over $1 million home, even though they were intended to serve those with modest means. Should FHFA reevaluate the 2022 update to the conforming loan limits to ensure Fannie and Freddie are serving low and moderate income individuals?
So, sir, this is a statutorily required calculation that we've done every single year, and we are following the law and the statute as written, and we're happy to work with you all if you'd like to change it or tweak it.
Well, on safety and soundness, $1 million home sounds like quite a bit for your mission, but I appreciate your consideration. Yield back.
The gentleman yields back. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
I have a couple of comments on comments made by our Republican colleagues. First, on inflation. Thank God Democrats pushed for fuel economy standards. If we were still getting the fuel economy that I got in my 1975 Plymouth Fury, we'd have to buy 3 times as much gas. We'd have triple the demand for gasoline. And so we would have much higher prices, and we'd be buying 3 times as much. There are those who say we should end the conservatorship. I think the GSEs are and should be government agencies. They make money for the government, and they give us much lower interest rates than we would have otherwise. They do so because we have a government guarantee of the debt risk, while the private sector assumes the interest rate risk. If we didn't have Fannie and Freddie, we would, et cetera, we would not have 30-year fixed-rate mortgages. The shareholders were wiped out in any economic sense in 2008. They do not have a right to have us, at our cost, rehabilitate their private banking entities. And what we saw is that when you have the GSEs strive for profits for private shareholders, but have a full government guarantee, you have socialism for the well-connected and the rich, and you have a bad system. Now, Ms. Thompson, you, in response to one of my Republican colleagues, asked you why you don't limit the GSEs to, in effect, lower middle-class loans, and you correctly responded, because Congress has told you to do really the entire middle class. And under the formulas, we have a conforming loan rate of $647,000 in most of the country and $970,000 in high-cost areas. And that's pursuant to congressional enactment. And that $970,000 loan gets you a 3-bedroom home in my district, whereas the $647,000 gets you a 4-bedroom or 5-bedroom home in Nebraska or Kansas. So the question I have is, why do we have higher fees on some conforming loans, those in higher cost areas? Congress has said that a conforming loan is a conforming loan, and in a high cost area, a conforming loan is up to $970, and the GSEs have decided conforming loan, there's real conforming loan and there's not so real conforming loan, and the 3-bedroom houses in Sherman's district will be subject to a big fee. Why are we treating all conforming loans equally?
Let me say that the conforming loan limit, again, is required by statute, as you've stated. And for many of the conforming loans, even for first-time homebuyers, especially in high-cost areas, if they have an area median income less than 100%, there is no fee. And that's true across the board. So I just wanted to make
But
sure. that
somebody
you
with
that.
an income above average in Nebraska gets a conforming loan, and somebody in California gets a penalized conforming loan. That's not what Congress provided. But I want to move on to another question, and that is these PACE loans. In effect, the agencies you oversee draft all the mortgages that are used in the country. Those mortgages contain a paragraph 4 that says you can't have a superior lien. But under these PACE loans, you in effect do have a superior lien. Why aren't you requiring these GSEs to modify their form so as to clarify that, that under paragraph 4, you can't get around the requirement of turning the first mortgage into a second mortgage just by calling it a part of your property taxes? Why don't we amend paragraph 4 and protect the GSEs from this?
Well, certainly that's something that we can look into. The enterprises having a priority lien status is pretty important, but we can certainly.
And under these PACE loans, your first is turned into a second.
Well, that's a requirement, and again, we can look into that.
I look forward to working with you on that. And finally, I hope that you would change the lending caps on multifamily. We have a crisis. The rents are too damn high, and people are sleeping on the streets. I yield back.
Thank you. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for being here. The GSEs have been in conservatorship for 14 years now, and former FHFA Director Calabria made it a priority to get these enterprises out of government control and back in the hands of the private sector. He had a clear focus for the agency, and every action seemed to be building towards that ultimate goal. However, since you've overseen the FHFA, it does not seem like there is a similar focus on working to get away from the conservatorship. So, Director Thompson, do you think there are any negative consequences if we retain the status quo of the GSEs in perpetuity?
So thank you. And I would say that we are working diligently to make sure that the enterprises have good financial condition, that they're operating in a safe and sound manner. And we think these things are prerequisites to them exiting conservatorship. We are making sure that they're retaining their capital and earnings, and we're also, again, focusing them on credit risk transfer so that we're taking incremental steps to prepare them. Certainly, there are pros and cons for being inside a conservatorship and outside a conservatorship, as I spoke to earlier, and we just think that, again, Congress can decide what it wants to do with the secondary market, and in the meantime, we will continue to prepare the enterprises in a safe and sound manner.
I'm concerned with a one-size-fits-all approach that we have on the FHFA and the GSEs are taking with respect to lease terms in the manufactured housing space. Fannie and Freddie are attempting to nationalize landlord-tenant law by requiring lease terms that are in conflict, frankly, or conflict with current laws of several states. And in fact, every state in the country would be out of compliance with the new national standards being set by the GSEs. So these changes were done without any stakeholder input, with one GSE simply publishing the change on its website. So, Director, are you concerned that your agency unilaterally made a single federal standard that is at odds with every other state's laws? And will you commit to be working with stakeholders to come up with a better solution than that?
So thank you for the question. We are always happy to work with stakeholders. We do believe that tenant protections are important, and we did have outreach sessions with various stakeholders to have a conversation about them. And the tenant protections that are required are giving notice to renters before they're evicted, or giving notice to a borrower before a rent is raised. But if there are things that are prohibitive, we're certainly willing to work with stakeholders at state or local level on these issues.
All right, I'm concerned about a trend I'm seeing out of the Biden administration where they just label anything that President Trump did as bad, and therefore it must be reversed. There seem to be a few examples of this coming out of your agency that were overturned without much justification. So quickly, Director, how did reversing Director Calabria's rule that limited the GSE's ability to purchase mortgages from second and vacation homes further the mission of the FHFA?
So we did not reverse that we put that provision on pause. That was part of the agreement that was embedded in the preferred stock purchase agreement that FHFA and Treasury are a party to. I'm a lifelong safety and soundness regulator. This risk management is what we do, and we certainly are looking at the loan characteristics, whether they're seconds or investors, and we're also looking at, debt to income ratios, we're looking at LTVs, we're looking at all of these things on a daily basis. And so these are the things that we ordinarily do as regulators and as conservator. And so, again, we are effective risk management and risk managers, and then safety and soundness is really undergirding everything that we do.
Okay. All right, Madam Chair, I yield my time back. Thank you for being here.
Thank you. The gentleman from Illinois, Mr. Foster, who is also the chair of the Task Force on Artificial Intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. And Director Thompson, in May of this year, this committee passed my bill, HR 7022, the Strengthening Cybersecurity for the Financial Sector Act of 2022. And this bill would give FHFA the authority to regulate and examine the third-party service providers of its regulated entities. This is similar to the existing authority that prudential banking regulators have over banks' third-party vendors under the Bank Service Company Act. The Financial Stability Oversight Council, FSOC, noted in its 2021 annual report that some regulators, including FHFA, quote, continue to have limited authority to regulate and supervise third-party service providers. So I'm very concerned about the risks that third parties may pose to individual financial institutions, as well as to the entire financial system, and given how interconnected our system is, and how many of these third parties are in fact core providers to not just one, but several financial institutions. So Director Thompson, could you tell us the extent of FHFA's current authority over the third-party providers to Fannie Mae, Freddie Mac, and the Federal Home Loan Banks?
Sure, that's a great question, and thank you for asking it. We've been asking, the agency's been asking for a number of years for the third-party service provider oversight. And this is something that is similar to what the banking regulators have through the Bank Service Company Act. In fact, when I got to FHFA from FDIC, I was very surprised that we didn't have that authority because, as you say, the services that are provided to our regulated entities are really important, and they could impact the safety and soundness of our regulated entities. And so we just want comparable authority similar to that which the other regulatory agencies have so that we can ensure the safety and soundness of our regulated entities. So thank you for that.
Well, thank you. And in your view, would it also be helpful for the FHA to have this authority to examine and regulate third-party vendors to the enterprises and federal home loan banks?
Well, I'm not sure I'm going to speak for them. If we can stick to the FHFA for this authority, I'd be very happy. Thank you.
All right, I'll let you off the hook on that one. But I think some of the logic, I think, sort of speaks for itself. And Director Thompson, while historically low mortgage interest rates have expanded access to credit for many borrowers by making the cost of lending more affordable, housing supply constraints have continued to lock borrowers out of home ownership. According to the Urban Institute and the National Association of Home Builders, housing supply is at the lowest level of the century, with just 2.6 months supply as of May 2022. The supply shortage is especially acute for low-income consumers, and many first-time buyers are looking for starter homes. The lack of supply, in turn, has led to record year-over-year home price appreciation. This measure was 17.5% for 2021, with some states such as Arizona, Utah, Idaho being closer to 30%. Now, some have said that this is a housing bubble that's imminent, reminiscent of what we saw in the lead up to 2008. And however, the high levels of home equity, they've been generated at the same time that we have a significantly lower level of subprime lending. And we have more responsible limits on credit and other reforms put into place by the Dodd-Frank Act, which hopefully have helped protect the safety and soundness of our housing market, despite the recent turmoil and the potential for future turmoil. So are you nonetheless concerned that record house price appreciation could create real estate bubbles in certain markets? And is there anything that should be done about that?
So I agree with you in terms of the increase in home prices, the increases in interest rates, and the current lack of supply. Actually, before the pandemic, there's been a persistent lack of housing supply. You know, one of the things that we have asked the enterprises to do is increase their LIHTC allocations so that they can start providing supply in low to moderate income areas to low to moderate income individuals. And affordability is just a huge issue, both on rental properties and in mortgages. And so anything that we can do to be helpful in that space, we will certainly take those steps. But as you know, the enterprises don't directly impact the supply issue, but we certainly will be working with all stakeholders to see what we can do to address that issue.
Thank you. I am nearly out of time and yield back.
Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Well, thank you, Chairman Waters, and let me say again, thank you for holding this overdue and very welcome hearing. Director Thompson, we're delighted, as I said in my opening comments, to have you back. Before you came to the agency, you talked about your background, 23 years at the FDIC, including as the Director of Division of Risk Management and Supervision. Mm-hmm. So that gives you a heavy dose of background in managing risk. Would that be a good description?
That'd be a good description.
And back in September of 2020, you were Deputy Director of FHFA's Division of Housing, Mission, and Goals, and that's what you were doing in 2020, right?
That is correct.
So you attended the FSOC meeting that was had on September 25th, 2020, where the council unanimously voted on a public statement regarding the secondary mortgage market. Is that accurate?
That is accurate.
That statement, which I have and I'd like to insert in the record, Madam Chair.
Without objection, such is the order.
I thank the chair. Highlighted the central role the enterprises continue to play in the housing markets. And it also described how any distress at Fannie and Freddie could pose a financial stability risk unless that risk was mitigated by the new FHFA capital rule. And so, and you voted to support that FSOC report?
Well, I was the deputy,
Yeah.
My principal supported.
Yeah, very good. Would you, if you'd been the principal, would you have supported it?
Hard to say. You know, at the time, that was a proposed rule that the FSOC wrote the statement on, and there were lots of questions about credit risk transfer. There were a number of comments, and I think that, as we've spoken earlier, the credit risk transfer program is very important. Mm-hmm. And so the statement was issued in September, but the rule was finalized in December, and so I'm not sure.
Okay. Well, looking back at that, there was a real effort to allow the two GSEs to gather capital and become stronger, not with any issue that they would immediately be eligible for release from conservatorship. You supported building the capital at Fannie Mae and Freddie Mac, did you not?
Still do, yes.
Yeah. So can you explain why you cut the capital ratio from 4% to 3%?
We issued through notice and comment a rule to make the leverage ratio buffer a dynamic buffer instead of a static buffer. This was something that the bank regulators did as well. One of the concerns that was raised was that the leverage ratio was becoming a binding constraint. Mm-hmm. And so it wouldn't, and we've got a risk-based capital rule as well that takes a look at the risk characteristics of the loans versus the leverage, which you well know. Yeah. And so, we wanted to make sure that the leverage ratio served as a credible backstop for the risk-based capital.
Let me reclaim my time. Thank you. I think you've explained that well. And when you look at the risk-based situation, clearly doing a stress test is an important part of that, right? And so what was CPI inflation in June? Do you know what that was? 9.1%? You agree with that?
9.1%.
Yeah, it was high, right?
It was very
So
high.
your stress test implies that inflation will be 1.5% between 2022 and 2025 in your worst-case scenario. Do you think that seems low?
Well, we haven't released our stress test scenario for this year, and we get our assumptions from the Federal Reserve like the other regulators, and so we'll be releasing that information in August of this year, the stress test for both.
Well, I hope that stress test will reflect the inflationary environment we're in and also the potential for a recession. So I'm glad to know that will be out in August. Let me turn in the few seconds I have left. You didn't mention in your prepared remarks about your pending products and activities rule, and when can we expect that?
Sure. So we've been working on that rule, finalizing the rule for a while now. And the issue that we're looking at is how do we marry the rule with our current conservatorship authorities as we look towards working that out. We will finalize the rule
This year?
in the near term.
Okay, well, let me again reclaim my time in the few seconds I have later. It seems to me in looking at your pilot transparency framework and your equitable housing finance goals, those are in conflict with not having that product and services rule. I think it's the cart before the horse. That rule should be in place, and then those agencies comply with those other policies with it. And Madam Chair, I'd like to insert in the record a good letter that Senator Tillis and Senator Toomey sent to Director Thompson dated July 19th. I'd like to insert
Without
that.
objection, such is the order.
I thank the chair and I yield back.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and thank you to Director Thompson for appearing before the committee today. Let me say at the onset that it is great to have an experienced and competent leader at the head of FHFA, especially at this very critical time in the housing market. I represent Columbus, Ohio, and the surrounding areas, and housing affordability is one of the highest issues facing my district. Unlike practically all of the other Midwestern cities, Columbus is growing. Between 2010 and 2020 census, the population of the Columbus metropolitan area grew by 236,000 people. That's 9 times more than the entire rest of the state of Ohio. And we are very fortunate that with Intel's incredible multi-billion-dollar investment in semiconductor manufacturing in the area, the growth is only going to accelerate in the next decade. And this is a great position to be in, but growth has put a huge strain on the availability of housing, especially affordable housing. We know what the National Low Income Housing Coalition has said. For our area, only 32 available affordable housing units for every 100 households. That gives us basically, Madam Director, about 50,000 units short. And so I'm very grateful for all that you have been saying to help us work on this. Although I know you don't do housing and you don't originate home loans, but I am very impressed that you said in your testimony that you are exploring the policies and programs to address the high cost of housing. But here's my first question. Everybody knows I'm chair of the D&I committee, and I have been on the record asking every one of your colleagues if you are aware of OMWI and what that means, and if you have an OMWI director.
Yes, we are very aware of OMWI, and we do have an OMWI director that reports directly to me.
Okay, and thank you for that. You'd be surprised that many have not had that question. Director Thomas, I also understand that FHFA announced that Fannie and Freddie contributed some $740 million into the Housing Trust Fund. And that, as I recall, is about a $29 million increase over last year. And so we welcome that news because, as you know, the Housing Trust Fund is an important important tool to produce and preserve affordable housing for low-income households. But the fact is, even with this increase, the Housing Trust Fund falls a little bit short of what we need in it. Can you speak to what impact it would be if perhaps we were able to double the size of the Housing Trust Fund?
Sure, thank you. So the Housing Trust Fund, the allocations that Fannie Mae and Freddie Mac make to both the Housing Trust Fund and the Capital Magnet Fund are through statutory formulas, and certainly it's based on acquisitions. We had a record contribution last year because Fannie and Freddie had record acquisitions, and so depending on the number of loans they purchase, that'll determine how much is contributed. The Housing Trust Fund is very important because we send the money to HUD and they distribute it to the states who have a good understanding of the specific needs in their respective areas. And so those allocations are very important. The money to the Capital Magnet Fund goes to the CDFIs, and they too can distribute money as appropriate to their local areas. But the Housing Trust Fund and Capital Magnet Fund are very important for impacting local housing supply.
Well, I'm very glad you said that before my colleagues, because I have a bill that I'm going to reintroduce that's called the GROW Act, and it will allow us to increase the contributions to Fannie and Freddie Mac into the Housing Trust Fund and the Capital Magnet Fund. I think I have a few seconds left, and with that, is there anything else, if I yield my time to you, that you'd like to say to us about your leadership or anything that you've been doing?
Sure, thank you for the opportunity. And again, I really just would want to reiterate that both safety and soundness and sustainable access to credit are very important to me. And I take the position very seriously. We have a huge responsibility. We have public confidence. And I've actually worked at FDIC and at FHFA, and I've had an impact and a chance to see what happens when public confidence is destroyed. And I take this role very seriously and just want to make sure that we are marching down the path of safety and soundness, good financial condition, and also equitable access to credit throughout the country.
Well, let me just say thank you. And Madam Chairwoman, let me also say for the record, while many other former directors have probably done a great job, but they have not reached out as Director Thompson has. So I want to be on the record and thank you for reaching out, for talking about housing far beyond the traditional means of coming before this committee, but I've had the opportunity to have some one-on-one time with you. Thank you, and I yield back my time.
Thank you. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry for holding the hearing, and thank you to Director Thompson for being with us today. I would just like to first express some concerns about the proposals that are attached to this legislative hearing today. We are over $30 trillion in debt. We are experiencing the highest inflation in over 40 years, and the majority has chosen to attach proposals like Build Back Better and the Down Payment Towards Equity Act to this hearing that would spend money we don't have, put people in houses they can't afford, and exacerbate the current inflation that is hurting everyday Americans, including Tennesseans back in my home district. With that, let me dive right into some questions. Director Thompson, during your confirmation hearing before the Senate Banking Committee, you stated that you, quote, have long believed that safety and soundness and access to credit are not mutually exclusive, close quote. While some actions that the FHFA takes may promote either safety and soundness or access to credit, there are actions that FHFA can take and prioritize that enhance both safety and soundness and access to credit, such as utilizing direct mortgage insurance. Will you commit to prioritizing initiatives at FHFA that will both enhance safety and soundness and improve access to credit?
Absolutely. Thank you for the question, because that is really something I firmly believe in, that is and both. It's safety and soundness and equitable access to credit, not either or. And again, we've seen the extremes on both ends, and they have to work hand in hand because the enterprises have to do things in a safe and sound manner, but they have to fulfill their mission to promote equitable access across the country through every neighborhood so that we have a good and functional housing finance system.
What about direct mortgage insurance? Would you speak directly to that?
Well, that was, I think, a pilot that the enterprises engaged in a couple of years ago. I'd have to take a look at, how what the results were and probably get input from stakeholders on the impact of that particular pilot.
Thank you. Director Thompson, I would like to follow up on some of the questioning that you've already faced regarding the GSEs. Do you believe that the conservatorships are unsustainable and need to end?
Well, the enterprises have been in conservatorship for 14 years, so I think that nobody ever expected that to be the case. As I know, again, at the FDIC, when an institution is placed into conservatorship, it's placed into conservatorship for a resolution, which is sale or some other mechanism. And so this is really unprecedented, what we've had to deal with for these past years. And this isn't something that there's an easy answer to. And so when the Congress makes a decision on the future of the secondary mortgage market, we certainly can do whatever we can to facilitate that, and we can try to be helpful to the extent that you all want to engage in legislative proposals. But again, I'm the 6th director, it's been 4 administrations, and we are happy to engage on this issue whenever you all would like.
Thank you. Do you believe that any government guarantee should be paid for and should come behind significant private capital in the first loss position, kicking in only in the most catastrophic of economic crises?
Yeah, I believe that that's one of the reasons that we're allowing the enterprises to build capital so that the government doesn't have to absorb any of the losses. There's another reason we're facilitating the credit risk transfer program, again, so that the private sector, not the enterprises and not the taxpayers, can absorb any catastrophic or unexpected losses. And we do believe in having skin in the game.
And I think you've sort of alluded to this, but are you going to make it a priority during your time to end the conservatorships?
I'm going to make it a priority to make sure that the enterprises are run as responsibly as they can be from an operational and financial perspective. Again, ending conservatorships is not a quick action to undertake. There are capital targets that have to be met. There are other policy issues that have to be decided by different stakeholders, Treasury, somewhat the Federal Reserve, and others. And so it's not an easy or immediate process. And we will do our best to make sure that when they do exit, that they're in good position, both financially and operationally.
And in the last seconds that I have here, I want to just renew a statement that I made to your predecessor, which is that back in my home state, a lot of folks still very concerned about compensation at the GSEs, particularly before the 2008 crisis. And if the taxpayer is going to be on the hook, we certainly want to be sensitive to that.
Absolutely.
Thank you.
Thank you. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chair, and I recommend Member McHenry and Director Thompson, congratulations and welcome to the committee. In terms of closing the racial wealth gap, what does FHFA stand on creating pilot programs that will allow the government-sponsored enterprises to purchase more non-conforming loans for communities development financial institutions?
So thank you for the question. FHFA required the enterprises, Fannie Mae and Freddie Mac, to submit equitable housing plans that looked at what are the barriers to home ownership and what are some things that they could put in place to address those barriers. Again, there are credit-worthy borrowers across the country that are not able to get homes, and some people don't even believe that they can have a home. And I spoke earlier about one of the programs that both enterprises have undertaken, which is to include positive rental payments in the calculation of the underwriting score. And that's a program that can be implemented just across the country. But we believe that people have paid, their mortgages and they pay their rent. The rental payment is one of the largest payments that people make on every month. And if you have someone that's paying their rent on time, that certainly speaks to their ability and willingness to repay, and that ought to be considered in the credit score calculation, and certainly can help responsible home ownership.
Okay, that's great. And Director Thompson, since you mentioned rental assistance, renters who are working hard and trying to save up enough for a down payment to purchase a home seem to be working against a moving target, which a strong year-over-year increases in home prices and rental costs, as well as increase in interest rates. What more do you think enterprises can do to ensure that those who are looking to transition from rental to owning a home are not left behind and locked out of the dream of home ownership?
So both enterprises have first-time home buyer programs, and I think working with different stakeholders around the country to make sure that prospective home buyers are aware of these programs, that they're aware of the requirements, and that they're ready for home ownership. We believe that there's a lot of information out there about the enterprises and their programs to promote responsible access to credit, and just working with other stakeholders to make sure that that information is available so that we can get credit-worthy borrowers into homes.
Director, climate change poses an increased threat to housing financial system. What is and I heard you allude to it earlier, the FHA doing to confront these changes, the challenges that they have with this climate change?
So great question. So from a housing perspective, we think of climate change from the natural disaster perspective. We look at wildfires and the impact of hurricanes and floods. And we want to make sure that the enterprises are well positioned to address these issues as they come up. For example, if a hurricane or a tornado takes place and there's a stated national disaster, homeowners are impacted immediately. The last thing they need to worry about is whether or not they're going to make their mortgage payment when they're looking for an alternative place to live. So making sure that we have good programs in place to help borrowers in their time of need, I think is very important. And as we're seeing more and more of these climate issues take place, making sure that people know that they don't have to worry about making their mortgage while they're actually trying to find adequate housing for their families. And so having forbearance programs and modification programs in place, we believe is really important.
Okay, thank you very much. And Madam Chair, I yield back.
Thank you very much. The committee will take a 15-minute recess and resume at 12:16. The committee stands in recess. The committee will come to order. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Chairwoman. And Director Thompson, thanks for your time here today. Thanks for the work you're doing, frankly, to make owning a home more feasible for more families around our country. We've had a lot of approaches here, and within the committee, I don't think it'll surprise anyone, we've got differences of opinion on how to solve a problem. The good news is this is one that we share a common objective. We think America is better and the American dream is more complete when more people own their homes. So I just want to run through a couple scenarios here. There are ways to maybe go about that. So hypothetically, if all borrowers were given a fixed sum of government grant money to purchase a new home, would the market respond by simply increasing home prices by the same amount?
It's hard to tell the answer to that question. I don't know that the market will respond by increase. I don't know how the market would respond, honestly.
I think economists would recognize that if you have an artificial insertion of, say, whether it's $10,000, $50,000, or $100,000, that setting that aside, let's say my colleague, Mr. Loudermilk, and I just agreed to purchase he's going to sell a home and I'll buy it, and we said, all right, $250,000 done. Okay, great, make it $300,000. What do you mean? We just shook on $250,000. Oh, we're going to get $50,000 from the federal government. That's effectively how subsidies work, and the things that we subsidize tend to be more inflated. I mean, we subsidize health care. Most egregiously, we've seen the problems of subsidies in education, and so what's gone is the rate of inflation in the things that we subsidize far outpaces the massive inflation we've seen in the United States. And frankly, I've been really concerned because the Federal Reserve created this artificial subsidy for housing for a long time. And they were soaking up treasuries that no one else was willing to buy massively, but they were also buying about $40 billion worth of mortgage-backed securities every month. That's not a direct subsidy, but it's an indirect subsidy. So how would that, how will FHFA adapt to the fact that, and how will the market respond to the fact that the Federal Reserve is no longer soaking up $40 billion worth of demand for these every month?
So I think the Federal Reserve made a comment about what actions they were going to take, and part of those actions were to let some of the mortgage-backed securities run off, and we've seen some of that take place. When we looked at the actual coupons of what the Federal Reserve Bank holdings were, I think they were looking at coupons or interest rates, securities with interest rates of like 2 and 2.5. And in today's interest rate, our current coupon is about 4, 4.5. And so we think that the Federal Reserve's actions certainly have started, and it is yet to be seen what impact they will have. But so far, we have not seen a significant change.
Well, you're doubling the cost of interest rates on homes. So the rate of interest is going to go up. We're seeing the market respond to that already. And so fundamentally that depresses prices, because for the same amount of money per month, someone who was going to buy a $250,000 home might have to look at a $200,000 home now because they can't afford the payment. The interest gets much more expensive, and so that has the effect of depressing prices. Conversely, when they were subsidizing, it had the effect of inflating prices. And so we've experienced this asset price inflation for nearly 2 years of the Fed dumping fuel on the fire. I think one of the hopes really is technology. So one, we could all continue to have these debates about continuing, hopefully, to turn off some of the economic distortions that we're seeing here. It's trending the right way at the Fed. Hopefully, come soon, there'll be an election that'll help it trend the right way here in Congress. But your office, I was encouraged to see announced, an Office of Financial Technology. So in this paragraph, I just wanted to say in the announcement, in preparation for the launch of the Office of Financial Technology, FHFA conducted discussions with peer regulatory agencies and industry groups. A key takeaway from those discussions is the value of consistent stakeholder engagement in helping to identify opportunities and challenges in the application of new technologies in the housing finance system. So do you go about that as approach with clear regulatory guidance or regulation by enforcement? And then what are some of the things that you view as promising as you're launching this office?
Sure. So it depends on the issue, which would determine, as is true with the banking regulators, what's implemented through guidance and what's implemented through statutory regulation. But as we engage with the other regulators, and we certainly do through with the FFIEC and also with FSOC, but each of the regulators has started an Office of Financial Technology or something similar. One of the things we wanted to do was try to figure out what lessons they've learned before we started our office, and specifically, we want to focus on technology impacts in the mortgage industry. And we want to see the technology that's being used, how it's being used, and to make sure that it's a safe and sound process, not just for the user of the technology, but for the borrower as well.
Thank you. My time has expired, and I look forward to cooperating with you as you develop that office. Thanks.
The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee, National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you, Director, for being here today. You know, the United States is suffering from a chronic housing shortage, as we know, and I believe it is well past time to implement a long-term national strategy to expand our housing supply. The first step to developing a sustainable and abundant supply of housing, of course, is to reduce the cost of materials and increase access to labor. To do this, Congress should take immediate action to fix our supply chains and strengthen our workforce by, among other actions, investing in skilled and construction trades. Director Thompson, from your perspective, what is the greatest obstacle to increasing the supply of housing in the United States, and what actions could Congress take to most quickly reduce housing costs for Americans?
So great question, and certainly the housing supply shortage is not new, and it's getting exacerbated, as you stated, through the labor shortage, labor costs, and the supply chain issues. And to the extent there are answers to address those particular issues, I think that can be very helpful in terms of just addressing the housing supply. If you've got the supplies and the supply chain is distorted and taking a long time, that has a huge impact on home builders, and it's just a domino effect. So to the extent that Congress has ideas about things that they would want to do, certainly we would work with them to figure out what would work for our regulated entities in a way that would be helpful.
And are there policies that FHFA are pursuing to increase the supply of affordable housing in the United States?
Well, you know, FHFA indirectly impacts affordable housing and housing specifically. We don't build. We are, as you well know, providers of secondary market liquidity, and we can incrementally impact housing. For example, we have allowed the enterprises to allocate low-income tax credit or the housing tax credit in rural and other properties that's specifically focused on affordable housing. We've also encouraged the enterprises to take a look at their existing, you know, ADU, the accessory dwelling unit programs, and also manufactured housing programs, which we think will be very beneficial in terms of helping the housing supply in rural areas where housing supply issues are particularly acute. And so, again, you know, we're happy to work with the Congress to do whatever we can to be helpful as we, as a nation, address this housing supply issue.
Thank you, Director. Now I'd like to shift focus to the ongoing credit score evaluation, which has now been in progress for more than 7 years. Over the past 4 years, I joined my colleagues in sending letters to 3 different FHFA directors, including you, about my concerns with a proposed multi-score option where the credit bureaus own one of the credit score developers, VantageScore. The credit bureaus already control the credit data that would be needed by any credit score developer to produce a score for this unique market. As a result, I don't see how creating a multi-score system which strengthens the credit bureau's market position is a viable consideration. I appreciate your recent response to my letter raising these concerns, but request that you further elaborate, please, on how the so-called lender choice option could address the vertical integration threats, consumer confusion, and a host of other problems that arise from this approach.
Sure. So thank you for the question. You know, we have not made a decision on the credit score model. As you know, both enterprises and most mortgage participants have used the FICO Classic model for over 20 years now, and there have been so many different changes and things that should impact credit scoring, like utility payments or rental payments, And there are just a host of other issues that are now more prevalent than they were 20 years ago. In fact, I don't even think they existed 20 years ago. But at the end of the day, making a change on updating the credit score model is a decision that we take very seriously because it's going to have significant operational and cost impacts, even if we move from one credit score to a new credit score. And so we want to be very thoughtful, and we want to engage with all of the stakeholders about not just what we do, but how we do it, because it's going to be very costly. Many people think that the credit score model.
You get a sense of that time? You get a sense of time? I'm sorry, I was going to ask you, get a sense of your timing on that, when you expect a decision? Do you have a sense of timing that's been coming? Just because it's been 7 years, you have a sense of, if that's something soon, you think?
Well, we're in the process. This isn't an easy decision, and we want to make sure that we're making the right decision because it impacts so many stakeholders throughout the nation.
Yeah, I mean, I just worry a lot because we know that's going to take another 2 years once it's decided. I just worry a lot about the impact it's having on homeowners and families. So, you know, just anything you do to keep us abreast of kind of that progress would be very helpful.
Happy to do so. Thank you.
Thank you so much, and I yield back.
Thank you. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Director Thompson, congratulations on your position. And it's a very important time, very tenuous time that we're in right now, that we be focused on the safety and the soundness of the GSEs. And I hope you'd agree with that. And I want to talk a little bit about some priorities of your office. And first, let me ask, where are you on the finalizing the rule for prior approval of enterprise products as the law requires?
Sure, great question. We are in the process of looking at finalizing that rule. We want to make sure that there's transparency in the activities of the enterprises, and we're looking at a couple different aspects. So we will be finalizing the rule.
So you are going to finalize the rule as it's written by law?
Yes.
Okay. I want to make sure, because my understanding is you may be replacing it with a pilot transparency framework.
No, the pilot transparency framework, just to be clear, there were a lot of questions about what the enterprises were doing in both their duty to serve plans and also the equitable homeownership or the equitable housing plans. And we wanted to have a framework in place to be transparent about what activities the enterprises were undertaking so that people could comment or, so you would just know what they were doing. And so that was just one step that we were undertaking because these pilot programs, some of them are included, and we want to have a transparent process where people know what the enterprises are doing.
So your pilot transparency framework is not going to replace the rule, and so you're still going to require public comment.
Well, we had a proposed rule, and we've received public comment on the proposed rule. We're taking those comments into consideration, and we're going to finalize the rule based on the comments that we received. But that does not take the pilot transparency does not take the place of the rule.
Okay. And that's why I'm asking questions, because there's perceptions, and in politics, perceptions can be reality. So we just want to make sure we're in the right place. And, on priorities, and let me first say that I agree, and I think everyone on this committee and should be in Congress agrees that there should be equity in all that we do, regardless of someone's background, someone's race, et cetera. And I applaud those that look at and to ensure that things are equitable. But there's been some issues that we've seen here in Congress that when you base a policy specifically on race, that is unconstitutional. We've seen that happen recently. And so I just want to make sure that the racial equity plans that we come forward with are based on the Constitution. And my concern is in Fannie Mae's recent racial equity plan, it never mentions safety and soundness, and Freddie Mac's only mentions it twice. And the fact that some of these are race-based, generally unconstitutional, which we saw in the American Rescue Plan, when a race-based priority was given to government subsidies, the courts ruled that as unconstitutional and struck it down. So I just want to make sure that when you're going forward, you're working within the framework of the Constitution.
Yes, absolutely. And thank you for the question, because I can assure this committee that we fully intend to comply with the law as written. And the equitable housing plans are certainly plans that are focused on underserved communities, similar to the plans that we have for rural communities, which are underserved, tribal communities. But we are focused on communities of color because they have been impacted by the housing crisis of the Great Recession and even prior to that. And so the things that are in some of these equitable housing plans will benefit all. I had mentioned earlier the positive rental payments. That would be appropriate for all borrowers or prospective borrowers.
And I've only got a few seconds left, and you mentioned the 2008 recession. That was brought on because really we were subsidizing people to buy houses they could not afford, right? Right now we're in a situation where the demand is outpacing supply. So how do you reconcile, one, that the Treasury Department is raising interest rates to suppress demand, but yet as we're trying to get inflation under control, but the GSEs are trying to artificially stimulate artificially through home buyer subsidies. Are they not contradictory here?
Well, I'm a safety and soundness regulator first and foremost, and everything that the GSEs will do will be grounded in safety and soundness, and that includes access to credit. We've already seen what happens when unsustainable loans are made and people had loans that they didn't understand and couldn't afford. We're not doing that. We want to make sure that access to credit is sustainable, that not only do people get in homes, that they stay there, because it's completely disruptive for borrowers, servicers, you name it, to have an unsustainable system.
The gentleman's time has expired. The gentlewoman from Iowa, Ms. Axney, who is also the vice chair of the Subcommittee on Housing, Community and Development and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Director Thompson, for being here. Very much appreciate it. And I sure appreciate hearing the word rural in the last 5 minutes, I think 3 times. So thank you and your team for all that you're doing for rural housing as well. Just over 3 years ago, some of my constituents living in a manufactured housing community, as you mentioned, are good opportunities for getting people into homes. This was one in Waukee, Iowa. They received a notice that their community had been sold, and then their rents were set to be jacked up by 69%. Many of these folks are people who are living on fixed incomes. They're, of course, now struggling to afford food and keep a roof over their heads. But to make matters even worse, that community, just like hundreds of other communities like theirs across the country, saw rent and fee increases, and it was a community that came in to buy them was backed by Fannie Mae. So having these kinds of predatory rent increases benefiting from federal backing, boy, just seems so wrong. It's like adding insult to injury. And a few years ago, FHFA, Fannie Mae, and Freddie Mac worked on a set of tenant site lease protections. These are very basic things, as you well know, like notice of sale or closure of a community or the right to sell your own home in your community. But here's the problem. That community that I just talked about with more than 60% increase in rent, that purchase included those TSLPs, and the buyer actually got a discount to buy that community, but he's still jacking up their rent increases by 60%. So I got to ask you, Director Thompson, does that feel like the residents in that community are really getting protected?
Great question. We believe that tenant protections are very important, and that's why we require both Fannie and Freddie to not purchase loans, especially manufactured housing communities that don't have the tenant protections, and they won't get the duty to serve credit. I think we need to follow up on that specific example or the what took place there, because that's not the intent. In addition to putting these protections in place, one of the things that we do is we have the seller or the seller of the loan to Fannie or Freddie certify every year that these protections are being enforced. So I really would like to follow up with you on that specific incident.
Absolutely, and I appreciate that because we've got to make sure that we take care of this. So thank you. Now, can you explain quickly what the duty to serve obligations are and whether you think this purchase counts towards that requirement?
Well, in order to meet the duty to serve requirement to get credit from our agency for Fannie or Freddie, they have to have the tenant protections. And we asked the enterprises to put forth a plan as to how they're going to increase liquidity in hard-to-serve areas and rural in particular. So the duty to serve covers 3 specific areas: rural, manufactured housing, and affordable housing preservation. They submit their plans, and then we review them and approve them, and they have to meet those plans, and then they get credit. And then we assess their progress on an annual basis. And so here's what you said you were going to do, here's what you did you do it? And if you didn't, then there are lots of conversations.
Okay, good, thank you. So it definitely does count. And as I believe, this kind of action should not be counting as community here. And I'd ask you to look at those changes. So thank you for bringing that up, that your team will, because it's really important. And I got to tell you, it's incredibly frustrating for me and my constituents who feel like we're constantly, they're being put under the thumb of a landlord who's taking advantage of federal backing and not putting forth the protections that my constituents need. These are just average, everyday folks just trying to make ends meet, save enough for a dignified retirement and keep a good roof over their head. So in general, would love to see you and the FHFA strengthen the protections for residents of communities that Fannie and Freddie finance, require public disclosure of those communities, align duty to serve credit with the actual level of support for the residents, and work to give residents a strong right of first refusal to give them a chance to buy their own communities. You may know I've been working with Senator Hickenlooper on this. We have a letter that gives more detail on those recommendations, so we'll be getting that to you. And can I just have you commit to reviewing that letter and taking a look at some of these protections for manufactured housing?
Absolutely, we're happy to do so.
Thank you so much. I'll make sure the senator knows about that. My team and myself, we're ready to work with you and your team at any given point in time. I agree with you. I think manufactured housing could be much more impactful in helping get a roof over people's heads in this country, but only if the protections are really there for those tenants. Thank you so much. I yield back.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Director Thompson, and congratulations, which has been extended to you many times and much deserved. When I look at the housing market today, and really for the last several years, I think what we see is a clear supply and demand imbalance, which is jacking up prices. Of course, that was in many ways stimulated by 0% interest rates, which were held too low for too long. That aside, so homes are becoming more unaffordable. And it's pricing, especially young families, out of the market entirely. As you note in your testimony, that is the number one issue, is low inventory. Beyond increasing the GSE's equity investment cap, what more can the FHFA do to increase supply? For example, could Fannie and Freddie take steps to encourage more lenders to make more low-cost loans available for builders to buy land and construct less expensive starter homes for first-time buyers?
Great question, and we would have to take a look at the charter requirements for Fannie and Freddie to see if they were eligible to purchase construction or loans that had not, without the actual collateral, because they have to buy the loans on property that exists, not the to-be. But certainly, we would have to look at the charter requirements for Fannie and Freddie on that particular issue.
Anything else that you could think of within your remit that could boost the supply?
So again, as you pointed out, Fannie and Freddie have very little impact on supply. Certainly, they can provide liquidity for different types of mortgages. And you mentioned on the multifamily side, we talked about increasing the LIHTC allocation. On the single-family side, we've really been looking again at accessory dwelling units and also the manufactured housing. We think, again, that the manufactured housing programs that already exist at Fannie and Freddie can certainly be helpful in terms of providing liquidity to those who want manufactured housing.
Yeah, thank you. And I think that highlights a point that I think Mr. Davidson was moving in the direction of, which is the more subsidies we provide, the more that we do these sorts of things, we don't actually solve the underlying problem, which is the lack of homes. There simply isn't enough supply in the market. And this is especially acute in the places with the worst homelessness problems, because it's nearly impossible. For example, let's talk about like San Francisco for a second. Nearly impossible to bring homes online. It takes forever. It costs ungodly sums, and as a result, their housing crisis is probably as bad as any in the country. So I hope this committee will start to take that issue up in a major way. We talk a lot about housing, and we should, because as Mr. Davidson suggested, it's a shared priority for all of us. But until we do something significant on the supply side, I just don't see this solving itself. We got a minute and 40 left. So once again, the GSEs are growing in power and building up their implicitly taxpayer guaranteed debt. As it stands, the combined assets of the GSEs are over $7 billion, which is an amount greater than the combined assets of the nation's 3 largest banks. What steps is the agency taking to ensure that in the event of a market downturn, low-income buyers will be protected and taxpayers won't be required to once again bail out the GSEs?
It's a great question. The enterprises, as you mentioned, are responsible for a little over $7.5 trillion in
Trillion, I think I said billion, yeah, trillion.
No, but your point well made. You know, just over a year ago, they were allowed to retain all of the earnings that they made. And this has been just over a year, maybe a little about a year and a half now. And between Fannie and Freddie combined, they've got about $80 billion in capital. And so in addition to continuing to build capital, they're also engaged in the credit risk transfer program, because while they're building capital, we want to make sure that if something unexpected happens, or if there's a catastrophic loss, that we have transferred that credit risk to the private sector so that they can absorb some of those losses, and that those losses are not on the backs of the taxpayers or the enterprises.
And how do you feel about that at the moment? Do you feel comfortable with the safety and soundness of our GSEs at the moment?
Yeah, I feel very comfortable with the safety and soundness of the enterprises. We've had outstanding supervision programs, great people at FHFA that look at Fannie and Freddie every single day. We also actually benefited to some extent from the portfolio perspective from the low interest rate environment, as many borrowers took the opportunity to reduce their interest rates. And so I would consider that de-risking the existing portfolio. And so we are in a good condition. We are concerned about some of the market volatility and some of the rapidity with which these changes have taken place, the interest rate increase, increase in home prices. And so we keep our eye on that.
Thank you. I yield back.
Time has expired. The gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair, and Director Thompson, nice to see you. I have great sympathy for your position, because I feel like all of us who are responsible in some capacity for housing policy are deeply schizophrenic. On the one hand, we want houses to be a store of wealth and increase the wealth of the American people. On the other hand, we want housing to be affordable, and anything we do to push one of those levers hurts the other. And I think we've seen it a lot on this committee today, right? Whether or not we think about housing inflation as being a good thing. From 2010 to 2020, a period that I think all of us would agree was not a particularly inflationary period, we saw median wages in the U.S. over that 10-year period grow by 9%, only 9%. CPI was up 20% during that period, and median home prices went up 50%. Those are numbers to prove what we all know, which is that it's gotten harder and harder for most Americans to buy their first home and start accumulating that wealth. And I had this conversation recently with Larry Summers that you can put a part of the blame for that on the fact that way back in 1983, we actually took housing prices out of the CPI index. There was a concern that this was going to eventually bankrupt Social Security because housing prices were going to grow so quickly. And the result of that, in part, has been that the Fed does not raise interest rates as quickly to rising house prices as they otherwise would have. And so I wonder if you could comment, just number one, how you see in your role, how you balance that tension between wealth creation and housing affordability. And number two, how you think should we put actual housing prices, not what would you pay if you didn't have a house? Should we think about putting housing prices back into CPI so that the Fed can actually get out ahead of housing bubbles beforehand?
So that's a great question, and I haven't really thought about whether or not we should put housing back into CPI. I'm certainly happy to work with you and have to do some research on that particular issue and get back to you and your staff on that. In terms of the balance, again, we try to balance all of the different factors, the market factors, the other issues that pertain to the activities of our regulated entities. And so there's always a healthy tension, as you mentioned, between the home prices and also affordability. And again, our view is to make sure that safety and soundness is first, and that we are making sure that we're providing liquidity across the country to those who are eligible and able to purchase homes. And so striking that balance again is important, because sometimes there are factors, as you've mentioned, that we just can't or didn't plan for. But again, we've got pretty restrictive programs in place that make sure that we're not allowing loans to be made that cannot be repaid and that borrowers cannot afford. I think that those are really some healthy tensions in terms of affordability and the home price
Well,
increase.
I'd love to continue the conversation. It's a tricky issue, but at a minimum, it seems to me that if wealth is growing faster than income, that's going to disproportionately accrue to the upper ends of our economy, which is what we're seeing. Second unrelated question. I know you've gotten a lot of questions about Fannie and Freddie and conservatorship, and I understand you're not going to go on the record with what might happen there, but it strikes me that you have a fairly unique vantage point because you oversee all these other federal home loan banks, many of which are, unlike Fannie and Freddie, don't have this innate conflict because as a federally backed for-profit institution, they behaved in ways that got them into conservatorship in the first place that you didn't have to deal with the other FHL banks, because the other FHL banks structurally don't have a conflict between their customers and their shareholders. And I wonder if you would consider having a conversation that if we are going to eventually get Fannie and Freddie out of conservatorship, can we think about learning the lessons from the other FHL banks and maybe changing the structure of Fannie and Freddie so that they don't have the incentives to get back in? Because again, I think within the banks you oversee, it's not coincidental that the one that went into conservatorship that blew up was the one that had the conflict of interest, the two that had the conflict of interest.
We're happy to have those conversations.
Okay. Well, let's follow up with your office, and I will yield back the balance of my time. Thank you.
Thank you. The gentleman from Wisconsin's Mr. Stile is now recognized for 5 minutes.
Thank you very much, Madam Chairwoman. Thank you for being here, Director Thompson. I appreciate your time with us today as well as your testimony. I read in your testimony you noted that at the FHFA, we took decisive action to support the market and provide relief to borrowers and renters with mortgages backed by the enterprises. This is in relation to navigating through the pandemic. And you said our actions allowed millions of Americans to stay in their homes. That's a great thing for so many Americans. Do you believe that during the pandemic, FHFA's response to the pandemic fell short?
I believe that the pandemic was unprecedented, and I believe that FHFA and the regulated entities worked together to ensure that borrowers were protected and stayed in their homes, and also that renters were protected as well. And I think that we worked really hard to make sure that the losses were not, because nobody knew what they were, that they would not be exorbitant.
Understood. And so I would agree that I think we navigated through that reasonably well from an FHFA perspective, and I appreciate your comments. The reason I bring it up is earlier, I know in a previous statement, going back a little bit, our chairwoman said, quote, "I'm very concerned about FHFA's response to this pandemic has fallen short, and that Director Calabria, like Trump, is putting his personal agenda ahead of the American public," end quote. So I disagree with that, and it sounds like from your words you do as well. Let me jump on to the next topic I want to cover. I'm curious in particular about the capital requirements, how we're building this up, in particular in your role as both a director, or as both as a regulator as well as a conservator, and how you're analyzing building up those capital requirements and what actions are being undertaken under your direction to do that.
So
and
we
how you
have-
balance those two hats.
So we have an Office of Conservatorship, and we also have an Office of Supervision. And the Office of Supervision operates in a similar way to supervision responsibilities at other federal regulatory agencies. And so they supervise. We've got a supervision team for the enterprises, and we have a supervision team for the home loan banks. The Office of Conservatorship looks at the infrastructure of the enterprises, and they also work with the Division of Housing Mission and Goals, which works on many policy initiatives. So we have a huge governance infrastructure that evaluates some of the policies and practices of the enterprises, but we have a separate team that oversees supervision.
Understood. That's helpful clarification for me. Is it a goal in your role as the director to continue to build capital at the GSEs?
Absolutely.
Perfect. And so I'd like to take that in that context then and ask you a question about a decision you made. Under Director Calabria's FHFA, we put in place a cap, put a portfolio cap on vacation homes and investment properties, which you removed once you took over. And I'm curious on the justification and the purpose for that. In the note that earlier today, you said you think it's important that we move risk to the private sector. And so I agree with that. And so how would you explain to a voter in Kenosha, Wisconsin, who's concerned that their tax dollars are at risk for the GSEs, and in particular as it relates to vacation properties and second homes?
So I would say that the FHFA and Fannie and Freddie monitor risk. There is a role for seconds and investors, and in many cases, the investor properties are in minority or low to moderate income communities. That would be true in Kenosha or Milwaukee.
The vacation properties are in low to moderate income properties?
Vacation properties might be in Adair County or other.
If it was in Wisconsin, right, it'd be one of the most high income areas in the state, right? They're often, vacation properties are usually, people who have second homes traditionally are not low-income individuals.
So
All right, I'm going to head over and vote then. I know I was up a few people.
Mr. Lynch, if you could mute during my time, that'd be great. Thank you. Go ahead.
So we monitor the risk. We monitor what comes in for investor properties and second homes. And just because I did not remove it, we are monitoring the risk through our conservatorship authorities and our supervisory authorities.
Appreciate your comments. Let me just share my view on this. Is I think anytime government risk is being backed by shareholders implicitly or explicitly, in this case implicitly, I get really concerned when we're looking at fancy pants vacation homes, different than, in particular, low-income individuals who we really got to make sure we're getting into that home. When we look at expensive homes, I think that's a different bucket. Appreciate your time. I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is also the vice chair of the Subcommittee on Consumer Protection and Financial Institutions, now recognized for 5 minutes.
Thank you, Madam Chair. Really appreciate your holding this critical hearing, and Director Thompson, appreciate your leadership at the FHFA. Blatantly racist policies like redlining denied Black families home ownership opportunities throughout much of America's history, and we are still seeing the effects of those laws today. In fact, the WBUR analysis of mortgage lending in Boston, a city in my district, the Massachusetts 7th, found that between 2015 and 2020, Black applicants were denied mortgages at 3 times the rate of white applicants. This is modern day redlining, and we need intentional policy solutions and tools to end this discrimination and create equity in our housing market. Director, every family has the right to a stable, safe, and affordable home, but for Black families, this right has truly never been actualized. Director Thompson, last December, you acknowledged that special purpose credit programs are important tools that can promote equity. Fannie Mae and Freddie Mae both cite these programs as ways to help promote credit access and reduce barriers to home ownership for Black and Latino borrowers. However, these programs remain dramatically underutilized. Can you share with us your plan to ensure the special purpose credit programs reach borrowers of color who are disproportionately underserved?
Sure, thank you for the question. The enterprises, as you've mentioned, have published these equitable housing plans, and contained in those plans are provisions to utilize the special purpose credit programs. And we are making sure that, all of the programs and policies that are in these equitable housing plans come before the FHFA so that we can understand the risk, we can understand the impact both on low to moderate income families and communities of color. And we really believe that the SPCPs, or the special purpose credit programs, are going to be a really good way to facilitate equitable home ownership in a responsible way, working with different stakeholders.
Thank you. And Director Thompson, Fannie Mae and Freddie Mac's practice of charging loan level price adjustments disproportionately impacts Black and brown borrowers due in part to limited access to wealth for large down payments. These fees are pricing many Black and brown borrowers in my district around the country out of the mortgage market altogether. Will you commit to eliminating loan level price adjustments? And have you considered how this change could help struggling homebuyers actually achieve equitable access to home ownership?
So thank you for the question. We have asked Fannie Mae and Freddie Mac to undertake a holistic pricing review, which would include the loan level pricing adjustments or delivery fees, and also the guarantee fees. And we are going to look at the submissions and take into consideration the impact that pricing has on all of the different segments, including communities of color. So that's a priority for the enterprises for this year, and we will commit to taking a look at, again, the pricing and the impact on different areas of impact.
Thank you. And with the Federal Reserve's recent interest rate hikes, homeownership is even further out of reach for many working class families due to the increased cost of mortgages. So really some layered challenges there. Director Thompson, what policy options is the FHFA considering to offset rising interest rates and assist first-time home buyers who lack intergenerational wealth? Would you agree that post-purchase counseling, or say a reserve account to assist borrowers with home repairs and other financial hardships, will help in that regard?
Oh, I absolutely think that post-purchase counseling is extremely helpful, especially when a borrower gets in trouble. That was one of the lessons learned from the Great Recession, that borrowers were not calling their servicers when they were getting in trouble with having to pay their mortgages or when they couldn't pay. And so early contact is really important. And so we think that that's really just fundamental. The other thing that you mentioned that I think is very important are the what I call liquidity reserves, or what happens when the hot water heater breaks and you have to go into your savings. I mean, these are the things that really need to be talked about, as we enter and embark into home ownership, because these unexpected expenses can certainly have an impact on households. And the more information borrowers, especially first-time home buyers and first-generational home buyers have, is going to be just crucial to the sustainability of the mortgage.
Excellent. Thank you.
Thank you. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Director Thompson. Thank you for being here. Are you familiar with the intern graduate opportunities that are available at the FHFA?
We have interns at FHFA. I'm not sure if that's the exact name of the program.
Sure. I'm looking on the website. You've got internships for, I guess, college, high school level people. You got recent graduate program, presidential management fellow, research assistant program, different levels of different qualifications, different pay structures, obviously, because some of them have more qualifications than others. That makes sense. Have you ever been involved with any hiring or recommendations for any of the positions I just talked about?
No, I have not.
You don't? Do you have any idea what they make?
I do. The high school interns is a new program. We certainly work with the other regulators like the OCC, SEC, and other financial regulators. I'm not sure what the
You would agree it's probably not more than $100,000 for any of those positions
For an
annually?
internship?
Yes.
I have no familiarity with the
Sure.
pay
No,
scale.
that's-
And
that's
we
fine.
actually work with, with our other regulators to figure out what our pay structure is going to be.
If they did make over $100,000, do you think they should be subject to ethics and disclosure requirements?
Well, I think everybody should be subject to ethics requirements.
I like that answer. That's very helpful. So you don't have any like fellowship programs where you have like a couple dozen people making $250,000 a year working for you?
I'd have to take a look so I could give you an accurate answer.
Probably not though, right? You would know about it if you did.
I should know about
I
it.
guess one last question. Would you allow any of your interns or graduate fellows to do interagency communications, kind of speak on your behalf in a capacity as an intern or a fellow? Probably not.
I don't allow my direct reports to speak on. We speak on behalf of the agency.
Sure.
I'm not.
That's fine. That's fine.
Yeah.
All right. Completely different line of questioning.
Okay.
As you know, in November of 2015, Congress enacted the Equity in Government Compensation Act of 2015, which capped the compensation that the chief executive officer of each GSE could make at the levels in effect at the start of 2015, which was $600,000 per year. Then in March of 2019, FHFA's Inspector General found that the GSE had sought to evade compliance with that law by creating new executive level jobs, quote, acted to circumvent the congressionally intended cap of $600,000 on CEO compensation. The housing ranking member, French Hill, sent a letter to your predecessor, Director Calabria, about this issue in 2019. My question today is beyond the chief executive officers to whom that law applies. Are there any current employees at any level of either Fannie Mae or Freddie Mac who are currently making more than $600,000 in an annual salary?
I don't believe that is the case. I would check with the Ks and Qs that are issued by the enterprises. They do have at-risk compensation, but I don't believe that there's any individual within Fannie or Freddie that has a base salary of more than $600,000.
Okay. I guess I'll give you some homework. If there are any, could you tell us how many, and we'll submit some questions, and then could you supply a list of those positions and their rate of compensation if anyone does exceed $600,000? And we'll get you something in writing. It's okay. I guess, would you agree that if anybody is making more than that, while the GSEs remain in taxpayer-supported conservatorship, would that be a problem? I guess, to your knowledge, there aren't any that make more than $600,000. But if there were, would that be a problem?
Well, I want to be clear that the base salary is not, they can't have bonuses, but the base salary cannot be more than $600,000. They do have at-risk compensation. And I, again, would look at the public disclosures, and I'd also just get you the information that you wanted on that particular issue.
Thank you so much. I really appreciate you being here today. Madam Chairwoman, I yield back.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair, for hosting the hearing today. Director Thompson, thank you for your testimony and congratulations on your confirmation. I am delighted to have an HU graduate at the helm of FHFA, and I can't wait to see the great work that I know you'll do, Madam Director. I have 3 questions for you. Director Thompson, I'd like to dive right into something that we both care deeply about, the affordable housing crisis. In Charlotte and Mecklenburg County, which I represent, we need 30,000 units of housing to meet our community's needs, and that's why I proudly introduced the bipartisan bicameral Lifeline Act with Representative David Rouser and Senator Leahy and Senator Collins. And our bill would allow cities and states to use their already appropriated fiscal recovery fund dollars to serve as gap financing for housing that utilizes LIHTC. So, Director Thompson, do you believe that enabling local governments to use their FRF dollars as gap financing for LE-type units could help ameliorate our nationwide housing shortage?
Well, certainly I would love to get more information on that so I can give you a more thorough and thoughtful answer, and would be happy to work with you on this particular issue.
Okay, well, thank you. We'll make sure that you get the information. I do know that FHFA has been evaluating a new credit score model for a number of years now. So I wanted to echo the sentiments that Mr. Gottheimer made earlier. Director Thompson, can you provide a brief update on where the agency is in that process and give us a roadmap on what the next steps might be?
Sure. So thank you for the question. We have not made a decision on, whether we have not made a decision on the update for the credit score model. We are currently analyzing the submissions that we received for the modelers that have submitted their applications. The enterprises went through their oversight process, and we are now going over ours. And again, I mentioned earlier, this is a very complicated decision. It is very impactful for all stakeholders in the mortgage industry, and we want to make sure that we get as much stakeholder input on this decision as possible. So we are actively engaged in overseeing and reviewing the applications that have been submitted to date.
Thank you. Thank you. I have one last question. It's my understanding that FHFA's Office of Inspector General released a report on the third and fourth party services. Recently published a similar report, FSOC did. So can you walk us through your safety and soundness concerns if those core providers of technology services to the enterprises were to fail?
Yes, thank you for the question. And we have asked as an agency for a third service party provider oversight. We want to have the same regulatory authorities that the financial regulators have, the bank regulators in particular, over their regulated entities. And we believe that persons or entities that provide services to our regulated entities, if there is an issue that could impact the safety and soundness of Fannie Mae and Freddie Mac or the home loan banks, that we want to have the authority to go in and take a look and identify whatever the problem might be, because it could be very impactful. And we would like to have those authorities so that we can really have parity with the other financial regulators.
Great. Thank you very much, Madam Chair. I'll yield back.
The committee stands in recess. I'll get a member to come back because I won't be back. The committee stands in recess. We will return after the vote on the floor.
The committee will come to order. The chair now recognizes Mr. Norman for 5 minutes for questions.
Thank you, Chairman Green. Appreciate the opportunity. Ms. Thompson, thank you for taking your time to come. Let me ask your opinion. Why is it that someone can get a taxpayer back loan from Fannie or Freddie for a second home up to $1 million?
Sir, thank you for the question. We have a statutory requirement for loan limits, and the enterprises are allowed to purchase second homes, investor homes, and as long as they meet the qualifications. The loan limits are prescribed by statute for the different property types, and we certainly would be happy to work with the committee on any adjustments they would wish to make.
Do you think that would be something that would really send a message, for a second home, to be able to get a government, with the taxpayers on the hook to pay it off if it doesn't work out, for a second home up to $1 million? Do you not think that sends a message to all Americans that something's not right about that?
Well, certainly there are requirements on how many second homes, how many investment homes, and other property types that are different from single-family residential, which is the bread and butter of the enterprise's portfolio. So we do look at the volumes that come in, and we also look at the characteristics that come in. But with regard to the $1 million and the pricing, again, that's a requirement that we have to follow the law and impose.
If you could use your influence on that, I think that would send a strong message. Secondly, on Congressman Lueckermeyer's question, on affordable housing, and this is my line of work, I've been doing it for a long time. I don't know what affordable housing is anymore. What's affordable? What we are facing now, and I would no more start a project now. You can't get water heaters. You cannot get pipe to put the utilities in. The supply chain issues on top of the inflation is out of control. His question was, have you had an audience with the president and you said you had, but does he realize the severity of what he's doing with his policies, particularly with gas and energy? One thing that would unlock this country would be to go to our natural resources and start producing our own oil and gas instead of buying it from OPEC, which is 15 countries that don't like us. And I can't tell you the number of projects that are stopped because truckers try to get somebody with a GDL to drive a truck. They can't price anything. They're having a shortage of workers anyway. Anyway, all the above. You need to be pounding on his whoever's running the country, pounding on his desk. This is not right, and it's not right for the homeowners. As housing goes, so goes the economy. Would you agree?
I would agree that housing is a very important component of the economy.
Do you realize housing from footings to finished product affects over 142 different trades? That is coming to a complete standstill. And I'm from South Carolina. We have people coming there. I see more I see more California tags, New York tags, New Jersey tags. They're coming because of our low regulations, our low crime rate. And I would ask you to, for the sake of the citizens of this country, to bang on his desk and say something has got to be done sooner rather than later.
Congressman, thank you so much for that suggestion.
Now, on the GSEs, I heard you earlier going to the private sector, and I only got 52 seconds, trying to transfer the funds. What kind of discount rate do they normally buy these on? They're not going to take risk that they can't recover. What's your take on that?
Actually, Congressman, they sell, they have capital markets transactions that they sell, and they use a syndicated structure similar to what they do for mortgage-backed securities, and they sell based on the market rate that is available at that time. And they sell different tranches of these securities, and sometimes the spreads are wider than others, but many times some of these transactions are oversubscribed, which means that they can tighten the spreads. So we are trying to preserve and conserve the assets of the taxpayers, the enterprises for the taxpayers.
Well, thank you for your service. You're one of the few that have got a pleasant way you answer questions in an easy manner, and I appreciate that. I yield back, Mr. Chairman.
The gentleman yields. I'd like to thank our distinguished witness for her testimony today, and I'd also like to thank her for her patience today because we did have votes to interrupt our hearing, and you have been very gracious. So again, we thank you. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I ask that our witness please respond as promptly as possible. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record as well. This hearing is now adjourned.